A very good morning to you all. It is the 21st of May. Look who's back.
It's brilliant to be back, Rich. I was gone for about a week and a half, 2 weeks almost, and it was, I would say, like, beyond just not working, the highlight was, of course,
What have you done with Ronnie?
Sorry, not the highlight. The worst part of it was not to be here with you, mate. So I mixed up my words there.
What have you done, mate? You've lost weight, you've got a decent haircut.
Fat shaming for my mom is one thing, but then when you add Rich fat shaming into the mix, then I realized I gotta step my game up.
I also hear your sister was shaming your haircut.
She was. I sent her a pic of me in the studio. And I was like, oh, look like I'm looking much slimmer. And she's like, yeah, whatever. But that haircut, what's going on there, big man?
Let's see it. Let's do a back inside.
Oh, come on, we got like
Look at that. Slick.
Big shout out to my guy Dan at Jimmy Slicks. That's my barbershop.
Dan at Jimmy Slicks.
Proper geezers.
Brilliant. Right, and who have we got? We got Terence in the gallery today. Terence is back. We got Cam. I think this is about Cam's 10th day in a row. And producer Phil. We've also got Stephen sitting in the back of the studio. Our intern. You're in, intern, Stephen? For the week? Just for the day, a one-day internship.
Oof, probably lasted longer than your internships, mate.
Do you know what? I'll give you a story, Stephen. My second day of my internship was September 11th. And so I was coming down in the elevators from lunch because it was like 1 o'clock. And somebody said, oh, there's a plane hit the World Trade Center. It must be a Cessna or something. So I was meant to get off at the 4th floor, go into the research department. But I thought, there was only TVs on the trading floor. So I went down onto the 2nd floor and tailgated through security because my security pass didn't work, and was there on the trading floor as the second plane went in, and people thought it was a replay of the first one, and then so it was just silence. Everybody staring at the screens for about 10 seconds. Then all the phones just started buzzing and buzzing and buzzing.
Must have been really rough for a 35-year-old to start your career off like that.
Right, on that note, what is coming up on today's show then, people? So we've got Ronnie with us through till 8:35, and then the Bond guy is back. Reza from Wise Alpha with investing experiences. He is our bond expert. So with the Japanese bond auction being the worst since 1987 yesterday, I thought now was the time to get Reza back in to talk us through what's going on in yields and the bond market issuance. Then at 9 a.m. we've got all sessions open, followed by Scott Sheridan. Yes. Now, Scott is one of the founders of Tasty Trade. He is a little bit more behind the camera than Sosnoff and Bat. But this is the third in our series of introducing you to Tasty management team. And then what's that at 9:30? God, we're filling there, aren't we?
Oh yeah, talking shop live with my idol, Luke Moore, Big Pete Ward, and
your idol Luke, and then Big Pete.
Yeah, he's big persona. Big persona.
He's not in today yet, is he?
Big earners, they come when they want,
Yeah, he's got better things to do.
It's like Zlatan said, training starts when Zlatan comes.
Right, okay, so we've got lots coming up today. What happened to Vodafone yesterday? You saw it open down 1%. Whoosh, up we go.
Yeah.
So we're going to take a look at that.
I was reading the news this morning and I said, oh, Rich is going to have a field day with this.
I covered my short, thank goodness. I was short some stock against my short puts. I've got size short puts on. And thank goodness I covered the short at like 72.80 or something. And I didn't even see it until 3 o'clock in the afternoon.
Blimey.
So I have actually shorted some last night in the closing auction.
All that experience finally paying off.
Eh?
Eh?
Best performance stock in the FTSE? Yesterday. Right, let's go into some overnight action. So very good morning to you all. Boise, I think you're right. Has Ronnie been working out?
I have indeed.
Boise's question.
Fasted cardio and a gym program for my brother-in-law.
You fasted?
Fasted cardio.
What's
Like
that?
you run on an empty stomach in the morning.
Oh, is that a new thing? Is it?
I don't know. It's pretty good. You should try it out, mate.
Yeah, mate. Do you know what I do? I do have to. The boys are talking about booking Ibiza in
Oh,
July. I'm not going to Ibiza like this.
Oh, come on, mate. You gotta lay off the Gregs.
It's- Greg's did well yesterday as well. You missed that
They
one.
did. Gregs, Curry's,
Yeah.
JD Sports even.
So yeah, Curry's good numbers. What have we got to look forward to this morning?
So what do we have coming up this morning? So we got some pretty good results coming out across the UK, especially with, Telecom doing very, very well. Smith's Group did really well. Not to be confused with WH Smith. London Metric Property did really well as well. And SSE Energy, our beloved Scottish heroes, did quite well yesterday as well. So I think in the UK we have quite a positive morning coming in. We'll see how it opens up in the US because we broke sort of a winning streak yesterday. So we'll see if we bounce back or if we continue the downward trend.
Yeah.
What are you looking forward
Well,
to?
let's go straight to JD Sports and see the final paragraph there. So overall trading in line with the first quarter of the new financial year. Despite this volatility, uncertainty surrounding the impact to you of tariff changes, literally copy and paste from the Vodafone outlook yesterday. We look forward to the medium term with confidence that we can continue to outperform the market, improve our profit margin, and create significant value for our shareholders. So yeah, 2% drop in sales.
And 100 million share buyback program. I know that gets you excited.
Yeah, 100 million.
Yeah, peanuts.
Vodafone are doing 2 billion.
In a day.
Yeah, 100 million. So yeah, so decent. Let's see.
I can't say I've never been a big fan of JD Sports, mainly due to the strong competition in that field. But we are coming up to pretty, important sports year, right? We have the World Cup coming up.
So in 2026.
Next year, yeah.
It's only May.
Yeah, but I think we're like sort of building up to that. I think we're seeing a bit more like summer purchases coming in now. My long-term view on JD Sports, I'm still quite skeptical to the whole thing. I think it's such a competitive landscape, but they proved me wrong, so I'll have to stand corrected on this one.
Yeah, and you saw when you were off, Foot Locker got bid for.
Yes, I did.
Huge premium. Screen off, guys.
2.5 billion. It was from Dick's Sporting Goods.
Yeah.
And Dick's Sporting Goods is a company. After that, I sort of, even though I was on holiday, I did look into it, and they're doing some really interesting stuff in terms of, yes, they're acquiring, Foot Locker and becoming like a main retail actor in that space, but they're also doing quite smart purchases in terms of technology advancements. So they're buying sort of like social media, like workout and training apps targeted at young people. So they're becoming sort of the main go-to place for amateurs, student athletes, professionals, all the way up. So
which category are you?
I am would be professional if it wasn't for the knee injury. And you, former Commonwealth Games runner.
What is it when you get to a certain age? There's a certain age group, the veterans.
The veteran.
Yeah. World Veteran Championships. I'm on my way. Right, the boys he's saying, did he say pasta and cardio or fasted cardio?
Fasted cardio.
Very good. Monkey Man says, yeah, fasted running's an old thing.
Yeah, Monkey Man knows.
That. Yeah. Right, let's look at Currys then. So Currys raising their annual profit outlook again for a third time. How did we miss this one? Now, that is a company with a fantastic social media. The things they do in store and post on TikTok is absolutely brilliant. It's genius.
But I've had the worst customer experience I've had in my life was at a curry store.
Go on. How long ago though?
This was like a year or so ago.
All right.
Like it was Curry's in Whitechapel. Like it took me like 30 minutes to get help from someone. I was trying to buy like a charging cable for the Xbox controller. And I was like, does this cable work? He's like, yeah, for sure. And I was like, can you just take it out and try? It's like, yeah, I guess. And it's like, oh, it doesn't work. So if I didn't say anything, you would have just let me buy this.
I must say that's not the experience I've had, and clearly not the experience.
No,
others
I
are
mean
having.
that's what I mean as well. I thought that I was doing like out in the field research there,
Yeah.
realizing. But Currys was a company that was sort of, they were deemed to be an underperformer. They were getting private equity interest about a year or so ago. It seems like they fought that off with these excellent results. So
Definitely. I mean, like for like sales are only up 4%. It's not like it's, you know, game changing, but still compared with the rest of the high street.
yeah, but also long-term view on this. What's your long-term view on this? Because I'm thinking, you know, going forward, you know, if we have sort of economic downturn, less disposable income, will clients go and buy a new TV? Or will they go to, you know, Facebook Marketplace to buy one instead? I'm wondering how sustainable this is. Does it say anything about their outlook? Have they remained?
Well, yeah, they've raised their guidance, but you know, you can see here where Ronnie's talking about. It started 2024 down at 50p, and you know, quite an incredible recovery. Let's bring that into a little bit closer, show how far they've come. Yeah, it's been absolutely stellar, hasn't it? You are right though on the potential for a slowdown, and that takes us on very nicely to our next story. And that is those inflation numbers this morning. My goodness me.
Yeah,
Didn't quite expect that.
I don't think anyone did really. I guess in hindsight, it's easy to say, oh, well, we cut rates and the UK government wants to spend a bunch to get stimulus going on and whatnot. So, but I mean, it's not something that's positive. We've had 2-3 rate cuts now, and we're cutting when the Fed is not cutting. So I think, if anything, this will lead to, you know, a pause in the rate cuts.
There's two things, right? Yes, it will put them into a little bit of apprehension, right? And it certainly emphasizes the wait and see. Is inflation going to be stronger for longer, or at least more persistent? But there are a lot of technicals in these numbers. Let's just take a look at the economic calendar and get the actual figures, apart from the ones that were in the FT. And yeah, so 3.5%, 1.2% month on month. Now, this is largely driven by services, and it's a lot of the bills that we all get, right? So it's vehicle duties going up, council tax going up, and don't I know that? The effects of national insurance. So these things have all gone up because of inflation last year.
Yeah.
Right. So it's not just backward looking in the last month, it's backward looking to this is sort of the hangover from inflation of the past 18 months. Forward looking, are you stepping into a world more of a slowdown and consumer spending dropping?
Yeah, that's what I mean, as well as your water bills are going to increase, your energy bills are going up. So people are spending less of their disposable income on, you know, products rather than services. So I think we can see, you know, a slowdown. If we see a drop in the inflation rate, then we might see a cut. But I think if we stay at this level, I'm quite, you know, pessimistic that we'll see another cut coming up. But I think, like you say, it's more of a lagging indicator more than anything.
Yeah, pretty dull week on the economic calendar this week, isn't it? There's nothing there. We've got on oil change. The oil stocks change at 3:30, just the usual weekly detail. We got a 20-year bond auction tonight at 6 p.m. Just be aware of that with the way that bonds are acting at the moment. We'll talk to Reza more about that in about an hour's time. But yeah, what's it done to cable?
Let's have a look, shall we?
Let's have a look at these futures markets this morning. S&P definitely coming off the boil, back to where it was about 7 o'clock last night. But you can see there, GBP 134.5. 134.5. It is up 45 basis points.
It's a high level. I mean, do you think, I think this is the sort of range that will stay in between for now. I think we see some positive news coming out of both camps, right? EU-UK trade deal, as well as the US sort of pausing on their tariffs and etc. But what's rather interesting, an interesting indicator that I read about this morning is that ETF providers are seeing a big inflow in global ETFs. So the flow is going sort of out of the US. People aren't betting as strongly on the US economy anymore.
Yeah.
And it's sort of the consensus seemed to be that the biggest loser from these tariff wars will be the US itself. So I think we can see a stronger cable than this going forward.
Now, will the US be a winner today or a loser? That's the big question, because, of course, we have the one big, beautiful bill that is trying to get passed as we speak. It's going on at the moment. Let's hear your Trump impression, go on.
Oh, no. I'm not stepping into that one. That's all you, big man.
The one big, beautiful bill. Right, there we go. So Trump pressures Republicans to pass that big, beautiful tax bill. He's nigh on threatening them now. He's saying that some people are holding out in the Republican Party, are holding out for a few deals and things they want, and he's not going to give them it. He flat out said they're just not going to get it. They need to get on the bus.
What's the sort of for someone who's been on holiday for 2 weeks? What's the summary of this? If you give me the sort of bullet points, what's...
Get me started.
Okay.
So there is good things in this, right? There's cutting regulations, and there's cutting some spending.
Right.
But the main thing is the big tax cuts that he put through in 2017, right? So in 2017, taxes came down a lot, and the S&P went to the moon. Right, because you had a lower tax rate, so your EPS was better. But those taxes always had to roll off. They were for a certain amount of time, the tax cuts, right? And that was in the budget, and that's how they managed to get it through, because they said, right, those tax cuts are only for a certain amount of time. Now they want to put this bill through, but they want to put it through from where taxes are at the moment, not from where they should be by the end of the year, because obviously as a tax cut rolls off, taxes go up, and they go up by 6 to 8%.
Oh, blimey.
Right? So at the end of the year, as things are, taxes would be significantly higher, right? To get this through, they're ignoring that. They're saying, oh no, taxes are where they, all we want to do is keep taxes where they are or cut them slightly. But it's complete lies, and it's complete fabrication of the numbers, because taxes aren't where they are, they're meant to be higher.
Yeah, so he's working from the previous basis level and not the revised one, yeah.
Exactly.
And
so it adds trillions to the deficit.
Which is just what they need, right? I mean, it's sort of the biggest concern. I think the biggest concern on a macro stage is the American debt levels. Like, eventually this whole debt bomb would blow up. Don't look at me when I say, don't call MI5, please. Trim the beard for a reason, guys.
He said it. Come and bring them in.
Trim the beard for a reason. But if you listen to, I don't speak to Ray Dalio, but I listen to Ray Dalio, and he's talking about, he's a big sort of proponent of this increasing the debt levels, and it's unsustainable, because everyone is sort of rolling it over to the next administration, because nobody really wants to deal with it. But this will cripple not only the US economy, but the entire world economy, and especially when they start pissing off their biggest allies, who's going to buy their debt?
That's the big question. He has got trillions to refinance over the next 7 months.
Yeah.
And how is he going to get that through? That's why he's arguing for rates to be cut. So all in all, this is why Monkey Man is saying it right there. Wow, look at Bitcoin. So 107, approaching 108,000. Gold, 3,317. Closed my short on that yesterday, because that really is The perfect story for gold is Trump getting this through Congress.
Yeah.
Because the dollar fiat currency generally is just a joke yet again. And government's irresponsibility.
Yeah, the prints are going at absolutely the highest capacity, and it's short-sighted. It's not sustainable. It's damaging to the global economy, the U.S. economy, and he might survive, until the next one, until he gets out of the office, but eventually this will catch up with everyone, right? And
well, it's not me, unfortunately. It is your age group and in turn Stephen's age group. Mate, you're screwed. Sorry.
Yeah. Is that why
Good luck on getting a job.
Is that why you don't recycle?
What's the point in recycling? What do you think happens? In New Zealand, it was quite funny. They had a recycling bin and they had a normal bin. We found out after about 6 months, they all go in the same place.
We had the same in my uni. We had it was like a separated entry, and then if you lifted the lid, it was just one big bin bag. Oh
I'm very good actually. I don't use plastic bottles anymore, and I make sure that I get all the.
But what's the actual added? Was it around 5 trillion that's going to be added to the national debt that's predicted for this?
On recycling?
No, not on recycling. Sorry.
Over his time period, yeah.
Yeah.
Yeah. But this is, if they get this through, then the bond vigilantes saddle up, and this could actually be a problem far sooner than we think. So at 5,910 on the S&P 500. That's yours, my friend.
Yeah. What do you think will be the sort of the reactions?
I think gold could go to 3,500 on this.
Yeah, again, yeah. I mean, it's not impossible. Gold to 3,500. Trade live with IG to 750 subscribers. That's the goals. That's what we're going for, right?
Yeah. Andrew McKelvey, why was anyone who pays bills surprised at the inflation numbers? Andrew, you're completely 100% right. I'm scared to open my council tax bill.
I have it on direct debit. I just don't look at it. Just take.
Yeah, I need to give in and do that. We've got. I think that's a new commenter. Is it? Is that all 102 JG? Not sure what that is. But are you not annoyed by the new caps on bottles? Yes, it drives me absolutely insane. I mean, look.
Yeah, it's annoying.
It's
annoying.
So annoying.
I mean, is it a?
Yeah, they're saying it's green, so you can. Right. Okay. Now talking about the chat, we have got the new updated subscriber number is 716. Whoa. We're getting there, people.
Moving up the world.
So 716 subscribers. We want 750 for the weekend. Or producer Phil has to come in on Saturday.
He does.
Yeah.
And intern Stephen will have to run the show then.
Actually, yeah, we'll give the intern the run of the social media.
Exactly.
Yeah.
That was actually Rich's first question when he saw him. He said, "Oh, hi, I'm Rich. Nice to see you. You know anything about social media?"
yeah. Right, we're going to break. We're going to have, after that, upgrades, downgrades, and some pre-market prices for you. So join us in 2.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Good in council tax.
I've just listened to that Tasty advert for the first time. Mutuo interessante. What is that?
That's the Americans trying to sound, European.
A glass of vino with the boys. What? Who recorded this?
Cheeky Beveragino.
A cheeky Beveragino. Did it say that as well? Right, okay, but that is, of course, our big evening coming up with Sosnov and with Bat. And Bat and I have got, we've got beef. So we're going to have a
Who do you have beef with?
discussion.
British American tobacco?
Batista.
Oh.
Anthony Batista. So, yeah, we're going to come along and see us on the 20th of June. And so it's only a month away now. Producer Phil is going to put the link up in the chat, and it's free. You get a B-Ross, Beveragino, glass of vino with the lads. And the boys, of course, there are women coming as well.
Yes.
The boys mean Bat, Sosnov, and myself. We've also got Jolie's going to be there giving platform demos of Tasty. So that's going to be great. And Ronnie's going to come along as well.
I wish. They're not sending me to Milano. It's just in London.
Yeah, we're talking about the London one, yo.
Oh, I thought okay, yeah, I mean, I guess. Producer Phil's telling me he'll be there, so if he's there, I'll be there as well, Cheeky Beveragino with Big Philly.
So yeah, let's take a look at the flyer there. So there we go, back for more. Yes, they are.
Damn, that's a charming pic of you, mate.
It's not bad, is it? I don't know where that one's even from. So yeah, go to sign up, and that takes you onto the Eventbrite website automatically.
$3.99
are free. I'd say $3.99.
$3.99.
$3.99. I've never heard that before.
Hey, I come up with new stuff all the time.
Right, what we see in pre-market then, JD Sports, a huge unchanged expected. So that's on their operating profit of 903 million against an estimate of 879. Q1 trading in line with views. Marks and Spencer's looking down 2%. Marks and Sparks. That was my first day of my internship.
Marks and Sparks?
First day, Tony Charette took me in to meet the CFO of Marks and Spencer's.
Oh,
and they were talking about the strategy, and they were talking about, why basically sales were a bit tricky. Remember, this is in 2001. And I was dying to say, your clothes for teenagers is just terrible.
You should have.
Yeah.
That's good insight.
Helped.
Imagine being the CFO of a publicly traded company, and you gotta sit and take critique from a 21-year-old Scottish intern.
First day.
Yeah. Pal, don't really like what you got going on here, pal.
Marks and Spencer's down 2%. That's on full year results. Adjusted pre-tax profit of 875 versus 837. But remember, the cyber attack impact 300 million on that cyber attack. SSE unchanged prelims. The full year adjusted profit 2.42 billion, which is in line with estimates, and a full year dividend of 64 pennies. We ready? 5 seconds, Ronnie. Welcome back.
Brought to you by
Ronnie.
LSEG.
Brought to you. Go on, say London Stock Exchange.
London Stock Exchange is bringing this bell ringing to you.
Right, what are the big moves we're going to see then? Is Marks and Spencer's only going to be down 2? And where are we going to see Curry's? Curry was looking up 2%. We'll go on to the retailers in a second. There it is. Marks and Sparks down 2.5%, £3.59. What do you think there? In the chat, what do you think?
I think, personally, no, you didn't ask me, you asked the chat, but I'll give you my opinion anyways. I think Marks and Sparks, they've shown really good turnaround. The new CEO that came in, he did a really brilliant turnaround. And I think the fundamentals of the company still there. I think this is, you know, I wouldn't say a hiccup. It's definitely a massive issue, and it showed a big flaw in the structure of the company and the safety of it. But I still believe that the fundamentals of the business are strong, and they're continuing the turnaround plan. So I think this is...
Ronnie, it's gone up 6 pence since you started talking. That's how long you've been talking for.
That's the influence.
Marks and Spencer's now only down 60 basis points.
When I talk, the people listen, mate. You should give it a go.
JD Sports are getting smashed, down 6%. So listening to Ronnie's... right, let's go to the consumer sector here, because that is where the interest is. Where is my... There's all my favourites. FTSE Clothing and Apparel, UK Retail.
Yeah, take your time, mate.
UK Retail, look at that, across the board. 8% now for JD Sports.
Oh, everything back to normal then.
Tricky. You stopped talking and Marks is back down 2.2. Now, this is, of course, these are being impacted by the inflation numbers as well. Your rate cut just went out the window. So we are seeing general red across the board. Curry's rather boring. Well, that's an interest.
Which one?
I'm tempted to take your lead and be net short of Curry's.
Yeah, I think that's a good shout. I don't see the long-term play in that. I think it's a very competitive field with small margins, and going into an economic downturn with smaller consumer spending, I think sort of the luxurious goods as of the middle class will take a hit.
Was JD Sports that bad?
Look at JD Sports, they're down 10.5% now almost, mate.
Was it that bad?
But Marks and Spencer, now that's a buy.
In your opinion,
in my
your
opinion,
for your fake account, sorry, your demo account. How's that been doing? Did you take all your risk down when you went on holiday?
I got wiped out in the tariff war, so I'm like,
it's not gone back on.
You know, I'm doing that. You know how they say those who don't know they teach.
Yeah,
that's what I do now here. That's yeah, that's why Rich is no longer working in the industry as well. He's here now telling you guys what to do.
Right, Poland Day results are in.
Oh,
what was better, Rich's Trump impression or Ronnie's Rich impression? That's quite comprehensive. That's the largest research.
That's like, you know, that's like a Russian election results, just strong. The people have shown what they want. 89%.
Russian election results. Yeah, I've got a few that's just as fixed. Right, so JD Sports posting a 2% fall in first quarter sales, warning that higher prices in its key US market could hit customer demand. I think we knew that already, that tariffs might hit. Oh, I don't know on this one. I think that's too much.
I also think the acquisition of Foot Locker by Dick's Sporting Goods is a big sort of threat to JD Sports.
No, I don't agree with that.
I think because they'll have a stronger market share, right? They'll have stronger advantages, economies of scale. I think it's going to be something that's going to be, I wouldn't say harmful, but it's definitely going to make them.
It's not a nice shop to go into.
Which one?
Yeah, exactly. Yeah. No, Foot Locker is just not a nice.
No, Foot Locker is ghetto. Like.
Yeah.
At least the one we have in Sweden, that one is ghetto. Like, it's in the middle of Central, and it's just like...
And the uniforms and everything.
It's a bit outdated.
I mean, well, there...
But that's what I mean.
Down 12% was...
That's what I mean. The Dick's Sporting Goods is the opposite. I haven't been to a Dick's Sporting Goods, but the company's doing brilliantly.
Yeah.
And coming under their umbrella is something that can revitalize it.
So you haven't been, but it's better.
I'm saying the companies ran better. Move on.
Right. So yeah, anyway, that is just the retail stocks. Let's go back to our wider look at what is benefiting today. Retailers are really the story, but Fresnillo up 2.3%, Severn Trent on the water train up 1.7%, and the rest, yeah, just Lloyd's continues to go. What an incredible breakout. This has got the momentum behind it, as do the other banks.
Oh wow, Lloyd's at 78.
And Barclays at 330.
That is. We got a client in our team manages. He only trades NatWest, Lloyd's, and Barclays. He's happy days for him now.
Yeah.
When we had results day, I think it was 2 or 3 weeks ago. I think we spoke about 20 times that day to sort of like just get everything in, doing all the trades. He's a brilliant trader, and I think there's something to learn from there. Find your markets and become an expert.
My friend, ex-colleague that works at Numis, moved his pension out of S&P about 1.5 years ago and put half of it into British banks.
Oh wow, that is
that's pretty good.
patriotic.
Yeah. Well, he's Irish, so not really.
Oh.
But right, so Avon up 8%. That's not the lady from. In Europe, what are we seeing there? Air France down 1.4, Mercedes-Benz down 1.3, Porsche, quite a lull around. Just it feels like the market's running into some resistance here.
Yeah, I mean,
DAX up 25 for the year.
It's still a very good year. I mean, we're not even halfway through it. It's quite interesting. I mean, Air France, KLM taking a hit. They're sort of following the footsteps of the American airlines. They took quite a big hit as well yesterday. So Norwegian Cruise Line was down, Carnival, Delta Airlines, United Airlines, all of them down. And so it wasn't surprising that the European counterparts are following suit. I think tourism as a whole is taking rather a big hit.
Yeah. So yeah, there's a chance that this UK inflation number is the canary in the coal mine of inflation turning higher again. With the tariffs, we know it's coming, right? Walmart are saying we're going to put prices up. Amazon, we're going to put prices up. So there was a Fed speaker last night that said a little bit worried here because none of the price rises are in the numbers yet.
Yeah.
So
Home Depot was saying that they're gonna try to keep prices consistent, but I think that's easier said than done. And I think with rising costs, it's gonna be impossible to sort of keep that.
Start off, guys.
And I think there's also talks about implementing sort of new tariffs or sort of congestion charges, if you will, for small packages. You know how the ones have often been exempt.
Yeah, you know about those, don't you?
I have no idea. I only know about average packages. But the sort of Shein, the Temu packages of the world, they're going to be affected by this. And what's interesting to see is, as a sort of polar opposite of this, we see Dollar Tree and Dollar General. They're doing really well. Yeah. They were up 4% yesterday, both of them.
However, I did notice a story at the weekend that the pound shop in the UK, unfortunately, the owners have put it up for sale.
Why?
Just because it's gone out of money.
Oh, brilliant.
Guess how much they're selling it for? Literally £1.
Seriously?
Yeah. The pound shop is for sale. It lost something like 200 million last year.
Blimey.
Yeah.
Well, their liabilities must be heavily exceeding their assets.
Oh, I don't think it's quite as much as a bargain as the £1 treats that you get in there.
But isn't it? I don't even think you can get stuff for put it there anymore.
Is that right?
No, personally, I'm more of a. I don't know. Have you ever even been to one of those, Rich?
Yeah, I'm Scottish, remember. I love a bargain.
I don't know. I see Rich in the organic aisle at Waitrose, looking at the matcha teas there and the soy milk.
It's all about a mix, Ronnie. All about a mix. There we go. Poundland set to be sold for £1. You couldn't write
I literally thought you were joking, man.
No, for sale. Times have reported the sale on Saturday after speaking to a source close to the matter. So, yeah, there's a queue out the door for it.
Yeah, we might as well go for it, mate.
Right, okay, so we haven't checked commodity world yet. Let's have a look at that, see how we're doing. I am on the gold train yet again. I did sell it in my ISA, so I don't have any there anymore. But gold up 70 basis points, 3,313.
Rich, you hit the
Nail
was
on
it
the head.
the 3,500 target that we had a bet on that you hit bang on the money? I'm not gonna make a bet with you again on this. I've learned my lesson, but I am giving you a challenge because you said it will hit 3,500 again. My question to you is when? Poll of the day. Can we get a poll in? Will it hit before or after August 31st?
It will be there in a month.
Oh, wow. That is big swinger.
Because if they get this bill through, then the money supply has just erupted yet again.
It has.
And all Powell's work to try and drain the excess funds out of the system has just been ruined.
Yeah. It's been reversed and even more so.
Yeah. And you've got, Bitcoin, 150,000.
A MicroStrategy will go like a rocket as well.
Didn't see yesterday's show, did you?
No.
Well, you've missed something there.
I try to avoid you when I'm not working, mate. No more than necessary.
Good. Right. Okay. Before we go to break, Ronnie's going to give us an update on how many dates did you have during your holidays?
2. But same girl, so.
Whoa! One of them said yes to a second date.
Hey, Hey,
It's the haircut.
You saw Boise in the chat. You saw everyone. What can I say?
That's why you got the big smile on your face.
Exactly. My mom was right. I'm a handsome boy.
My mother, unfortunately, agrees.
Oh.
Okay, right. We're going to go to break, and then we're going to come back with some markets that are fast.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Radio, welcome back to Fast Markets. We decided to put our money where our mouth is. So we said before the break, when is gold going to go back to 3,500? Why not look at an options price for it? So we have got the IG gold options market up, and there we see. Now, of course, it could go through. That's the worrying thing, right? If the bond vigilantes really get to work, then it could go even higher. But something like...
You know, Rich, I know you love your complex strategies, show everyone how good you are with all of that. Hedge risk. Oh, look, I'm only paying 2 cents for $25 of upsides. Well, whatever. Just naked call this. This is going...
Do you know, you've got a point.
You know, like... obviously, manage your risk. Manage your risk, always do. But I don't think gold is gonna work at some sort of like range. I think we're gonna see it. We've already hit unprecedented levels, and we see now that with the current administration and every sort of policy that's come into place, gold is just rallying even further. I think we can. I told him behind the cameras. I think he's right. I think gold will hit 3,500 within a month. I think we can even hit, I don't even think that's going to be the high of the year.
2 dates and he wants to go naked.
Hey.
Typical.
Third date, that's when it happens, baby.
Let's do it then. Let's look at the 3,450 for 69. So we'll buy the 3,450 for 69 at, that's going to be $10 a point. So that's $700. And the expiry is the August contract, but gold commodities are really weird. The August contract means that it expires on the 28th of July. So that gives us plenty time.
Yeah.
And yeah, I'm going to go for that one. Right.
So you can always close it prematurely to expiry.
Of course, yeah. But do we go bigger? No, I'm going to go bigger. I'm going to go $15 a point at 69. So that's buying, so spending $1,000 premium. But I am going to sell some upside.
I think, you know what?
At 30,
it's always
3,700.
It's always good to manage your risk. I think that's good. That's a reasonable take that you're doing there, Rich. You know, we meet in the middle.
Exactly. So I'm selling the 3,700 calls, which would be an extreme move, wouldn't it? And I get 20 for that. So I've spent 69 on the call, and I received 22 for the selling the call. And then I am going to have a conviction that this does not go significantly lower, right? So therefore, I have spent 69 minus 22, so that's 47. So I'm going to sell the 3,100s for the same size for 27 ticks, and then I get it down to 20. So I've spent 20 points for 250 points of upside.
Can't teach an old dog how to sit, eh?
Woof.
He's got that dog in him.
Right, there we go. So that is all on. Roll on the 28th of July, midsummer.
And speaking of sort of hedges against inflation and money printing, for our professional traders out there, with a massive risk warning that we do now have Bitcoin options, daily Bitcoin options that are available for our professional traders. So if you're looking, they're only, however, on daily expiries at the moment, and we're looking to expand into that one. It will follow shortly. But if you're a professional trader, if you're looking to hedge inflation, that's something worth looking into with the correct risk management in place.
Elliot Harris has been at work hard on that stuff, hasn't he?
He has been working hard.
That man, honestly, is so dedicated to the job, and he's done so much work on the S&P options and now on these new Bitcoin options, really improving the platform. So that's great news. And then, fast markets, we had a number last night to look at, didn't we?
It was, yes, it was indeed. It was Palo Alto Networks.
And how did that go?
They did quite well, actually, in terms of their earnings.
But just not the price action.
The price action was not anything to write home about. And
I was going to shout out to Piers, because Piers did call this. He said he wouldn't get involved and he would wait for a drop.
Yeah, I think Palo Alto Networks is a company that has a strong underlying business, and they're in the sort of right space. They're doing cloud software security in that sense. In that sense, it's very, very well positioned to capitalize on this sort of AI infrastructure and that sort of business that's coming up to it. It is, however, not very appreciated by the market. They've grown a lot through acquisition. So they've grown a lot through acquisition, sort of roll-up strategy. So they have quite a big sort of capex and interest card costs, etc.
Yeah.
I do think that Palo Alto Networks could be a potential acquisition for one of the big names. We saw Google, Alphabet, acquiring, what they call WizCloud, the Israeli company that they acquired for 30 billion. Not Wizz Air, producer Phil. He's trying to set me up. But they acquired, I forgot the name slipped my head now. And he's trying to trick me, but they acquired 2-year-old cloud company for 30 billion. So there is acquisition in this space, and with undervaluation, it's something that's attractive.
Okay, and there it is on the daily. It's right at the high. So a lot of the stocks in that industry are similar charts. It's been a great investment over the years. Right, what to do with Vodafone now? That's the last one I'm going to look at before Angeline comes in and grills you, not on your love life, but on your ideas there. But yeah, you can see this one. So let's just get to a mid. I think it went up way too much yesterday. I shorted them in the closing auction at 77.72. And you can see that one just down 2% this morning. Way too aggressive on the rally from that set of numbers. But, yep, fair play. They're certainly better than I thought the numbers would be after the CFO.
Tell me more, Rich.
Runner.
I'm really keen on hearing more.
Right, I'm going to leave. I'm going to moonwalk out the door. Boise, just to answer your chat, are you at a loss if gold goes past 3,700? No. You're essentially that call structure. You're buying it at 3,450 and you're selling it at 3,700. That's it. You're never short. So it's pure profit on the way up. The potential loss comes if it goes below 3,100. Then you are you're essentially long at 3,100.
Toast.
Right, we're going to do a really quick Ferrari pit stop, and Angeline will be back when you click your fingers in 1 minute. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hey, welcome to Fast Markets with myself and Ronnie. Fast in the name, fast in the motion. Can you see how fast we were changing seats?
Exactly. We're like a
my
Ferrari pit
goodness,
stop.
We are like the Ferrari pit stop. All fingers and all toes accounted for. Taking a look at some of the big movers, but drawing your attention to the indices first because, you know, boy, are we seeing a bit of a risk-off motion here. Some of the tech stocks as well moving lower, but we do also see the FTSE down just a touch after those inflation fingers. Is that something that you were expecting, Ronnie Bonnie?
Well, I wasn't expecting the inflation figures. I think more than anything, that's what caught me
To be so hot?
Yeah, that's what caught me by surprise, and I think it's quite evident that I'm not the only one who was caught off guard with that. And I think people are taking risk off more than anything, more than a long-term play. And I mean, the US indices sort of dropping back a little bit. I'm not super surprised by that with the fact that I had 6 days of winning streak.
Yeah, I mean, like the key thing as well that I thought was really interesting was I was watching interest rate futures, and it's still an 85%, people, trader friends, 85% pause expected from the Bank of England in the coming months. So it seems like, you know, on that end of things, it didn't really react very much. But, you know, we are seeing some reaction on the markets there. Predominantly, speaking of some of the consumer stocks, just having a look at JD, because I know you talked about this earlier with Rich, but it's now down 7.7% there. It was down a bit more. I wanted to show this to you because I know some of our trader friends have positions on this, and it is now retracing. So this is the minute chart for you. As I often say on the show, if you don't catch the first fall or the first spike, then you can always trade the retracement. You can catch the bounce, right? And so just bear in mind, we are now at that point. We are seeing this retracement, kind of like when you and Rich were opening the market, when you were hitting the bell this morning. It happened around there.
Okay.
But JD Sport, I agree, Rich. I don't think it should be whacked this hard. I think this stock has had a rough run of late, but it did start getting a bit of a win in its sales rather from around mid-April. Do you ever go into a JD Sports or not? Not your kind of thing?
No, we have one in Whitechapel where I live. I went in once and it was somehow they managed to stuff the shop with a bunch of stuff, but nothing that was of interest. So I was sort of off that. I'm more of an e-commerce shopper, I have to admit. But yeah, JD Sports, not the biggest fan of it. However, something that I am a big fan of, Ange, is, I don't know if it's CATL or CATL, is the Chinese EV battery manufacturer. They have now had their Hong Kong listing.
Again?
CATL.
Okay.
They have launched now. They're IPO'd in or their second listing now in Hong Kong, and they've had really strong results and growth coming. Even though we see the EV market sort of dropping off a little bit, but what's interesting is that they're expecting the truck market to be 50%. 50% of all trucks in China are expected to be EVs by 2028, and they are extremely well positioned to benefit of this. So that's one I'll be looking out for. Is that anything that you've been sort of? I know you're a big BYD fan. Is this
only when it's a pair trade with Tesla?
Okay, right.
Yeah, and that was the first quarter of this year. Trader friends, if you put that on, well done you, because that was a good pair trade to do. I'm not completely, to be honest, it's not one that I take a look at, but I'm glad you put that out to me, because China does have the infrastructure and the political might to get most of their trucks in the EV space. And indeed, they've already got mega cities out there where, I mean, you'd not believe it unless you saw it with your own eyes. Almost all trips in some of these test cities are already all fully automated. So you go in there, Ronnie will have his, Zero Coke and his popcorn. He can tap onto his favorite Netflix film. Do you use Netflix?
I do, yeah.
Yeah. And then you just tell the car where to go. Lots and lots and lots of people have tried this. So if you've spoken to people who've gone to those test cities in China, places like Shenzhen, the manufacturing hub, it's something that is not so random anymore. I guess it can be compared to the likes of LA or some of the test hubs in San Francisco, right? So a lot of people there are already very used to this. And what's interesting too is that we're probably going to see more and more of these green shoe options to increase offerings like these IPOs in this space going forward. Because don't forget, China also has the 3-2-1. You know what the 3-2-1 is? It's the level of, it's 4-2-1. So 4 grandparents, 2 parents,
and 1 child.
And 1 child. 一个孩子. So 1 child. If you're trading the space, this is a big factor because they're going to have an extremely old, aging population with not enough people, right? Yeah. To kind of support this infrastructure, this inverted pyramid, if you like. So anything that is EV, that is automated, that it's fully drive assist or robotics, this is going to be a big space if you're trading there. Speaking of robotics and also speaking of automation and high tech, want to check in on Avon as well. Avon Protection. Got very excited when I saw this morning. So Avon Protection, is this one that your clients trade?
You know what? I'm gonna be completely honest with you, Ange. I've never heard of this one before. Can you tell me what it is?
Avon is in the defense space. Mm-hmm. It creates all sorts of protection gear so that if you're about to go in and clean your bathroom, or Rich just to go and do his quick whip round before his inspection of his flat happens. No, I'm kidding. In the defense space, they make all these protective gear, right? So that if there's any sort of warfare, or if you are going into extremely volatile situations, they even make this sort of outerwear, or rather protective gear, for firefighters. And so I wanted to show you the chart really quickly because Avon Protection is in breakout, people. And you can see that on my chart. I've drawn that technical line there just to show you the last time it was back at that level, if you can see on the left-hand side, but we are at breakout there, up more than 7%.
I'll have to look into that one.
Now, and then just very quickly, we've got some Reza waiting in the wings for us. So I'm being told by producer Fred I have to do a hard out
Producer
now.
Fred.
No, producer Phil, sorry. Producer Phil, that we are having to go to hard out is what he's telling me. But just stay on the line because you've got Reza on. And for those of you looking at breakouts as well, highly recommend you look at gold because an oil is of resistance seen at 67. That's for WTI. So stay right there. We'll be back. Thank you so much, Ronnie.
Thank you.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Welcome back, everybody. So, when something big happens in the bond markets, this is the man that I call. Reza, welcome back.
Nice to see you again, Rich.
Thank you so much for coming in. Last minute, I called you yesterday and said, look, you know, Japan, we've had something go on there, as well as the US downgrade. So what is going on?
Well, I mean, you know, people are focusing on the credit risk of governments at the moment. So obviously there's a lot going on in the world. So last night, people were a little bit concerned about the latest Japanese bond auction. You know, it had less demand, less coverage than, you know, we've seen in the last 10 years. So people are particularly concerned about the long end. So what we call the long end, the longer dated maturities, the kind of 30, 40 year. And so,
as opposed to the short end, I'm guessing?
As opposed to the short end. And so, you know, that's also kind of fed into the market's kind of reaction rates have risen, you know, slightly on the short end and more on the, the long end. So the 40-year has gone up by, say, 0.5% over the last month or so and run up to that.
And can you just run us through exactly what that means? Why do rates move or yields move differently at the short end as to the long end?
Yeah, so it's the perceived risk. And so now the market dynamic is that there is a focus on credit risk of governments. And so the long end obviously means that, you know, there's greater risk in holding bonds for a longer period of time. And so people, you know, market participants, investors need to feel that there is a good solid strategy from central banks in order to, you know, in terms of their purchasing policy to maintain, you know, the lower rates or demand in the market for the bonds,
right?
You know, they need to look at the fiscal situations of economies, and so that's a little bit in flux at the moment. And so basically, there's a focus on risk of governments, you know, being able to pay back their longer dated debt. So that's why the longer maturities are, you know, seeing a little bit more of a higher rise in rates because of the higher risk.
And obviously, in the short term, you're guaranteed to get your money back.
Yeah, I mean, basically, unless something major implodes, basically that's the case. I would say that this is actually the new type of relationship we're seeing in terms of investors' thoughts. Previously, for example, the US was always seen as kind of AAA, risk-free, stable. And so, when there were times of economic uncertainty, people actually viewed US government bonds as a safe haven.
Yeah.
And so all across, the maturities of the US debt, you saw people, buying 30 years, 40 years. Obviously, the 10-year was the bellwether. That's the most liquid, part of US government borrowings.
Any reason it's 10 years the bellwether?
Well, it's where you got the right balance of risk and return, but it's also not too long dated. It's where the market focuses on it. So previously, when there was less of a concern about whether governments could actually pay back their debt, in times of economic uncertainty, actually yields fell, right? Because people were buying that as a risk-free asset.
Yeah.
Right now, we're in a different world where people are focusing on the amount of debt that Western and G7 countries have. And so, longer dated securities present more risk. That's why in Japan, for example, there is what we call a steepening in the curve, where, the rates at the further end, i.e. the longer maturities, are rising more than at the short end, the near term.
Okay. And it's the literal, as if you're drawing a line from the short end to the long end.
Yeah.
That's the steepening is.
It's like a hill incline getting larger, effectively. Yeah.
And what it's essentially when people talk about a steepening of the yield curve, what is that in layman's terms?
Well, it basically shows that there is higher risk and higher rates, higher cost of borrowing, for the longer maturities.
Because of the concerns about the sustainability.
Yeah, that's the environment we are in now, where the focus is on government debt sustainability, yes.
Right. And how do we rank the concerns amongst countries?
Well, I mean, obviously there's a lot of concern on the US because it's the largest market for government debt. It's the biggest by far, and the most liquid. So that's what everyone really looks at. Then you've obviously, the UK tends to follow the US somewhat, because the economies and, the policies tend to, or at least from a monetary perspective, tend to be aligned. Japan is also a very interesting one. So obviously, as you know, a lot of hedge fund investors have been borrowing from Japan.
This is the next,
Exactly.
sort of stage, isn't it? So,
yeah.
And that, of course, we saw last year in August.
Mm-hmm.
We saw a little snapshot of what might be to come.
Yeah.
So yeah, run us through the carry trade.
Yeah, so effectively, government lending rates or government central bank rates are, have been historically over the last kind of, 10, 15 years near towards zero, and so what hedge funds have been doing, particularly in the US, is borrowing from Japan, at effectively, zero, and then using that to invest in the US stock market or other areas where they see a higher return. So it's basically kind of, they see it as a free lunch, a free way to kind of make money. But obviously, if rates start to rise, currencies move against you, then that can cause, your borrowings to suddenly become expensive. You might have more margin calls because, your positions are underwater as well.
Let's just run through what that actually means. So I'm a Japanese bank.
Yep.
And you're a hedge fund.
Yep.
Right. So I've got, how much do you want to borrow?
Well, if I'm a US hedge fund, probably, as much as I can.
Yeah, just give me it all. So, right, I'll lend you 10 million.
Yep.
So what interest rate would you pay me for that 10 million? So you're saying roughly zero.
Well, it has to be a lot lower than what I would have to pay if I was taking it out in the US, for example. Mm-hmm. Right. And so obviously, with rates in Japan towards the zero end, then like I'm kind of, as long as it's, far enough away from, say, the 5% that's in the, I might have to pay in the US to a bank to get leverage there. If it's close to zero, if it's
but
zero,
generally
one.
it's been one. say 1%.
1%, yeah.
But then you have to take that and change the currency, don't you?
Yeah.
There you go. So there's your 10 million. So you borrowed at 1%, but then you've done an FX currency trade at 145.
Yeah.
So what? So do you hedge that currency position, or do you leave that at risk as well?
Well, I mean, I think the smart ones would do some hedging, but I would imagine that there are a lot who haven't, because they've had the mindset, well, it's stayed there for so long, I'm only going to borrow for the next couple of years, just, while the stock market goes up, and then I'll unwind it when I'm out of profit. That's just generally the mindset. So not everybody is hedging that risk. And, if you don't hedge that risk, obviously, if the currency moves against you, or, short-term rates in Japan rise significantly. So if you have to roll over your borrowing at the next payment date and suddenly the rates are higher, suddenly your trades, don't look as attractive.
Yeah.
And
so if we just put that graph up of the yen, so you have essentially, you've taken that 10 million and you've moved it into dollars at 144. So are you hoping the currency goes above 150 or below 140? You want it to go above 150, right?
Well, yeah, you want to kind of make money on the currency as well. You know. So when you have to pay back the yen, you want to have more yen to do that effectively.
Okay, so if this starts going the other direction, if the currency goes through 140 on the downside, then you've paid 1% to me, and you've invested to get 5, 6. But if you start to lose 2-3% on the currency, then suddenly the trade doesn't make sense anymore.
Well, that's right. And so then what you can see is, an unwinding of the trade, and what you don't want to see is a mass unwinding, because then suddenly, everyone's position gets worse, because, that loss gets magnified.
Yeah. And so what could lead to that unwind, in a, I guess, exacerbate the speed of the unwind?
Well, I think there's a number of different factors. I mean, at the moment, for example, one of the things that I think people are monitoring is the fiscal situation in Japan, right? So obviously, recently the Japanese government said that their fiscal situation is worse than Greece's. So there's a lot of scrutiny on it. So look, if the fiscal position in Japan actually worsens, so they're not able to keep things stable, I mean, obviously there's a bit of tariff uncertainty, then, rates can rise, central banks' rates can rise, especially if there's inflation, from tariffs that they have to deal with. So that can, cause the borrowing rates to increase, which again makes the carry trade less attractive.
Yeah.
And so as the carry trade is less attractive because you have to borrow at higher rates, a greater unwind happens. So that's one thing that people are focused on, And then there's just a number of, other factors related to the US, how is that performing, as a nation? I mean, I guess, that will also feed through into what the exchange rates are. So, you have to watch a number of different angles effectively to see, to see what's happening.
So let's get the Treasury curve up, or at least the numbers. So it's pretty tricky to see. Let me take that. So this is US Treasuries, and we're focused in on the 10s. Well, the 2s, the 10s, and then that 30.
Yep.
Yeah, that 30 back above 5 now.
That's right. Yeah. So yeah, it is. We're now at the highs. I mean, it could continue. I mean, in the US, let's look at what's happening there. So obviously, you've got a number of things which are offsetting, but obviously there's a big bill going through, which people see as potentially, increasing spending or, reducing some of the tax revenue that's collected.
Yeah.
What the Trump administration and Doge are saying is that they're going to make those savings up from wastage. So Elon's still sticking to his target of 2 trillion, just has to say, he's saying, well, as long as the government lets me do that, I'll find you those 2 trillion. But then you've got obviously Trump, who's looking to, reduce taxes, invest for growth. He's also been helped by some of the deals he's done in the Middle East. So with Saudi, UAE, and Qatar, that's
good place to do business.
Good place to do business. That's going to bring in $1 trillion, of investment into the U.S. economy. So all of these things are kind of, the market's working out how they all offset each other in their thinking. At the moment, the 10-year and the 30-year, the long end, the market is baking in a little bit more risk effectively.
Yeah.
There's still uncertainty on the trade side because the trade deals haven't been struck. Even though the US and China seem to have taken the worst case off the table,
yes.
By agreeing an interim deal where the US pays 10% and China pays 30% until the main deal is struck. There's obviously the UK as well. You've got
Let's go down to those UK bonds there. 5.5 on the 30-year.
It's getting interesting, huh?
What's breaking point in the US and UK?
Well, at the end of the day, central banks can always, they can always print money. Inflation is the tax on the population, right? So if these rates continue to rise, it's not going to be so much a break problem. It's just a worsening in the amount that, governments will be able to raise from the market, without having to take extraordinary measures. It's the cost.
That interest payment and liability, continues higher and higher. Chart off, thanks, guys.
I think the point is that you will eventually, if you continue this type of, increase in rates over a period of time, it then starts to make the whole model look unsustainable. And that's when you will reach a breaking point. So you kind of can't keep, spending and not being fiscally responsible for an extended period of time. And so basically, as long as they make sensible actions now, and even if it's gradual, that can take things away from, I guess, the breaking point. But certainly something we've got to keep an eye on because, once you start to get above, 4.5 in the 10-year, it starts to become quite difficult for consumers.
Yeah, because suddenly that interest on the net debt payment. So in the middle there with the big sign, like a nuclear sign, as they refinance this year, $7 trillion still to go, I think.
It's a lot, yeah.
At 4.5 or higher, it suddenly dwarfs the defense money. It dwarfs the social security. And interest on net debt is going to be the highest expenditure of all, isn't it?
That's right.
And as that rises, if the others aren't cut, then this number here, the budget deficit, the 2 trillion becomes 2.5 trillion.
Yes.
3 trillion. So then the national debt goes 38, 39, 40, 45. And then we're in real trouble, aren't we?
Yeah, we are. I mean, the US is the biggest bond market, so everybody is focused on that. If the US doesn't manage its borrowings prudently from here, it will affect everybody else. So, there's a big focus on it. I mean, everybody knows, now very clearly that you got to, try to reduce wasteful spending. A lot of the waste actually in the US is from all areas actually. So, healthcare costs, for example, are rising massively, and that's because the US healthcare system is geared to, creating a continually sick patient so that the pharma companies can make money. I'm just being honest because that's basically everyone knows that's what's happening, right? So they've got to sort that out. So that's why the Make America Healthy Again movement is so important. Because as soon as Americans start to be healthier, Medicaid and all the other costs associated will come down. The biggest form of spending, which has basically led to the situation in the US, is the war spending. So since 9/11, around 21 trillion has kind of been spent on security, both internally as well as externally, and war funding, etc.
Wow.
And so that's the biggest one. So, they got to kind of figure out how to wean the US off of being a kind of a war economy effectively.
Now, how does this all tie into corporate bonds then, which of course you're
Yep.
the expert in?
Yep. So corporate bonds are obviously, very sensitive to movements in central bank rates. So all the risk-free rates that banks can borrow at. So basically, when you see a rise in rates, that also consequently feeds through into yields or returns, and prices that corporate bonds trade at. In the recent last month, what you've actually seen is while government yields have actually kind of at the long end started to rise more significantly, and in the 10-year in the developed countries, high yield, which is the riskier part of the corporate debt structure, has actually performed better. So it's actually gone up a few percent.
Right.
And that's more as a function of the fact that, what drives corporate bonds is not just, rates that you see, central bank rates, but also the perceived economic risks and how that would feed through into the company's performance. So now the recession card seems to be kind of off the table because trade negotiations seem to be normalizing somewhat. Not there yet, but, people are feeling it's a bit better. Investing in the higher risk corporate bonds, is perceived to be a little bit safer now. So, people be buying back in,
So the tail risk is the bad thing because you don't want the company to go bust.
Yep.
But you don't really care what happens to the equity as long as they've got enough money to pay their
Well,
bonds.
that's exactly right. And even investment grade bonds, which kind of have tended to mimic, how the government bond curve moves. They've stayed more stable at the long end than governments actually, and that's fascinating actually because so for example, British American Tobacco, which has a 2052 bond, which is traded on our platform, it's got around 30 years, from where we are today. That has actually firmed a little bit in price, so it's gone up a little bit, whereas the 30-year UK government bond has actually gone down in price, and the yields have risen. And so people are looking at things at governments and corporates very differently. I mean, let's take the extreme example. Apple, has got a far superior credit rating or credit
than the government.
Than the US government. I mean, it's very interesting, and that's. The US. I mean, people thought that Moody's downgrading, the US from AAA by a notch was a big thing, but look, the market's already baked this in. I mean, everyone kind of knew it wasn't really there, in reality. So it's just a bit of catch up. So the market's taken it in its stride, but it's a sign of things to come if we don't fix things.
We got a comment on chat there. Andrew McKelvey saying, talking of UK bonds, that Scottish bond proxy SSE up 1.7% on the day on the back in numbers. Does SSE have a corporate bond?
They do actually, yeah. I mean, I think we have one on our site. I haven't looked at it in a while, but I don't know if it's a perpetual maybe. But they do have bonds.
So a lot of the companies, the sort of big UK companies, have got.
Yeah. Basically, a lot of the FTSE 250, FTSE 350 companies have borrowings as bonds. So investment grade bonds, or sometimes even high yield as well. Like I said, like Ocado, for example, has a high yield bond, 10.5%. Stock's been down. I think the last time I looked at it a few weeks ago, it was down 20%. But the bonds were steady, so they made it 10.5%. A lot of the major large caps in the FTSE have bonds. I mean, obviously the banks have loads of them across the capital structure. And Tesco and all the big, Marks and Spencers, all the big companies, they all have bonds. So, it's very interesting to think about which is going to generate you the most value in the next 5 years.
Right, we are running out of time because we've got the all sessions opening soon. Reza, what if people want to know more about bonds? There is a way, isn't there?
There is. So we're actually having a session tomorrow called "Are Bonds the Next Big Thing?" It's at Wise Alpha HQ. There are still some spaces, so if you want to come along to learn about what are the big trends in corporate bonds and how you can trade them, then there should be a very scintillating evening of discussion and knowledge about it.
Excellent. And not only that, it's at the top of the tower in Canary Wharf, isn't it?
It is, yeah, it is. So you have great views of London.
Amazing. Well, yeah, as a thank you for you coming on here, I'm definitely going to come along and be chatting to you there. So yeah, it's on Eventbrite, is that right?
It's on Eventbrite. It's also, if you find me on Twitter at Euroyield or on TikTok at that Bond guy. Also on LinkedIn as well, so you can find the invites there as well.
There's your TikTok there. He set it up since he was last in. And 500 followers, nice.
I'm building it up slowly.
I don't know when that picture's from though. That's not recent, is it, Reza?
that might have been a few years ago. Just a few.
Good stuff. Right, Reza, thank you very much. We're going to take a real quick look at the all sessions there. It has opened. I'm stealing this from Angeline because Angeline was meant to be coming in, but we've spoken for so long, Reza.
Yep.
Let's go through how the US is moving. I think the down moves will be most interesting. United Health there down 1.8 at 315. CrowdStrike down 1%. And Nvidia down 73 basis points. Nvidia's bounced to 133. That's incredible, isn't it? And then take us through this this treasury bond we see on the next line there, the 20-year. That's the TLT, isn't it?
This is the iShares 20 plus. Yes, yeah, exactly. That's interesting that it's it's moved down a little bit. Yeah, so I think the move is continuing.
Yeah. Good stuff. Right, I will let Angeline come in and run you through the rest of those moves. We'll do a quick 1-minute break. We're back with all sessions.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hey, trader friends, welcome back to All Sessions with me. It is like a pit stop here, like in Formula One. And we just had a quick tag team, Rich and I, and we are off to races. Let's have a look at the winners list because All Sessions well underway now, 4 minutes in. Virgin Galactic, they're up 2.7%. We also have Moderna, JD.com up 1%, both Moderna up 1.5% almost. And we are also seeing the likes of Novavax up 0.75%. Coinbase, they're not a surprise given Bitcoin as well. Recently seeing that rise up 0.2%. Car makers, EVs, Tesla Motors up 0.75%. Let's have a look at the losers list now. Palo Alto Networks down 3.8%, top of the losers list there. And Plug Power as well, down 1.7. Dougie, if you're listening to this, Plug Power is down 1.7%. Let us know, trader friends, which ones you are trading in the all sessions, because this is one of the USPs here at IG. You get to take a position before the US cash session opens. ProShares, Carvana, also up there, and Lyft and Micron Technology also riding higher. For those of you watching this space as well, just some quick heads up, because looking at Lyft there, I'm sure many of you are aware that Baidu are reporting soon as well. Baidu, of course, is the brand behind Apollo Go. Any of you familiar with the autonomous vehicle and service Apollo Go, let me know on the chat here, because it is one of the reasons why I think Baidu has got a strong future ahead, because many cities within China already have Apollo Go. Baidu, this is the all sessions there, down 1.5% at the moment. Baidu we're looking out for earnings per share reflecting a almost 25% year-on-year decline on its EPS. This is according to Mumu. There'll be also a live webcast as well. But if you just wipe my screen down for a second, producer Phil, we will just give you a quick look at what I mean by Apollo Go, because Apollo Go looks a bit like this. It is a car service, and here we are. You can find it on the website. You can do everything from asking it to actually take you somewhere, to putting on the massage as well. And we're going to skip this so that you can see what I mean, and look at all those white cars there. Those are all autonomous, and I believe there's already a fleet of 500 in Wuhan, if not more. But everything from the moment you board to asking it to roll down the windows, to Apollo, put the massage on. Apollo, put this music on. So it's like going into a car that someone else is driving, just like there's no other human in there. Okay, whack that down now, because I'm going to show you some others that are also expected to make waves potentially. Let's have a look at a Target now. Target is also expected out with earnings, and let's have a look at the shares, the price action there for you. This is the daily chart there for you. The earnings expected on the 27th, I think, but just putting this up for you because we talk a lot about consumer related stocks here. We've already seen Walmart out recently, but it's really the next quarter that we're expecting some of these consumer companies to really show how much tariffs have hurt them. Please do hit the like and subscribe button. We are not autonomous here, so if you want Rich and myself and Great and the Good like Ronnie and Luke to bring you instant news and live to your homes or wherever you're listening to us, please hit the like and subscribe button. We are wanting to get to, how many is it, guys? 750 by the end of the week. Where are we now, Phil? 7:15. So hit that like and subscribe button to help us get there and get us on our way to a new LSEG bell to replace this one. Right, Arthur Fox, hey, good morning to you. Which day recently was a show where Ocado bonds were discussed? That might have been last week. We'll look that up for you. Back to the show now. We have also earnings expected from Target, as I mentioned. I think this is in the next few sessions. Guidance for the full year of 2025 expected to come in around 1% for net sales. But Target is one of the companies that sit in the more vulnerable part of the US consumer spectrum. Walmart tends to hold well. Costco, if you're looking at shares year to date, has held up relatively well, but Target likely to be ones under pressure. Moving on, we also want to have a look at Tesla was down, I think, earlier. Let's have a check on Tesla. For Monkey Man, they're up, actually, up 0.6% there. I think I saw a story earlier on the week saying that Elon Musk has confirmed he is going to be around for, I think it was 5 years, Monkey Man. Did you see that article? Let me know if that is correct, or anyone on the chat. But take a look at Tesla, because I want to show you Xpeng, or Xpeng. And this is another EV maker in the more premium space, might I add. Xpeng expected to report its results today ahead of the open. Before I came into the studio, it hadn't yet broken. And the company also has a conference call at around 8 a.m. Eastern. Quick look, just very quickly, because I promised someone earlier, looking at oil, WTI there, and the technicals showing that we are in that range area there. WTI oil spiking around 64 on reports. Israel is set, it were to strike Iran resistance scene at around 67 a barrel. Right, thank you very much, Boston Frank. Yes, it was 5 years. And I have to now let you know that we are going to have a very special surprise after this. It's an interview with Tasty's Scott Sheridan, part 1, and we're going to have the second part tomorrow. So stay right where you are, pop that kettle on, and we are going to have Scott up next.
So joining me now is Scott Sheridan, CEO of Tasty Trade and one of the key innovators behind the rise in retail trading over the past 18 years. Scott, it's an absolute pleasure to have you on.
Thank you. I have to say, hearing about you and Tom talking about you, I feel like we've met before, but we have actually never met. So thank you for having me. Looking forward to it.
That's absolutely right, because I initially interviewed with JJ and then met Tom on the road, obviously. But, you know, obviously I see and, you know, need to try and see less of him. But, you know, it's a joy when you come on the program and give the live from the trading desk. Just
thank you.
From the viewers that haven't seen the Tasty show yet, run us through what part you are in that program.
For the Tasty Live, or for what I'm
Live, yeah.
So we do a piece. It could be anywhere from 20 to 30 minutes. It's called Live from the Trade Desk. So for anybody, hopefully everybody, I'm not dating myself. Hopefully people are familiar with the show Seinfeld. It was a big show back in 80s, 90s. And it was literally a show about nothing. And that's what I say about my segment. It's a segment about nothing. So the only thing that we know we are talking about every day is I come in with my top 15 symbols that have been traded so far on the Tasty Trade platform, so the first 40 minutes a day. So I do give that list every day. Other than that, there's no script. It's just typically I have a hook. Like, I know I'm going to start with something, and it could be what I had for dinner last night. It could be what I did. You know, it could be watching a sports game. It doesn't matter. Yeah. Rarely do we start off by talking about trading unless something crazy is going on with the markets. And we will touch a couple stocks here and there. But for the most part, it's really three guys sitting around talking, me, Tom, Tony, who have, you know, close to 40 years, you know, history together. So
that's
fun.
It's not three guys, is it? It's three best mates, and you've, as you say, you've got so much history together, and that's what makes it such compelling viewing. Because I would imagine to get up every morning and knowing you've got to go into an office with Sosnoff and back and appear on camera with them, it reminds me of when the school kids are in the classroom before the teacher enters, and then you walk in.
Well, it's funny because Tom and I, this is our 37th year together. And it's a long time. I mean, 37 years with anybody, especially with Tom, that's a long time. So I know what to expect when I wake up. But I have to say, every once in a while, there's still a surprise, like, never knew that after 37 years. So it's fun. It is. I really enjoy doing it. I'm lucky. I do feel that it's a privilege to get to come to work every day.
Now, take us back 37 years. How did you first meet? And then how did that develop on the trading floor?
So I will try to keep this short just because I know we have a limited amount of time. But Tom and I actually met in Las Vegas. So we went to, it was a bachelor's party. I did not know Tom. So it was a bachelor's party, and I didn't know the person getting married, but a very good friend of mine, still to this day, was one of the first people I met when I went down to the floor, said, why don't you come out to this bachelor's party? I said, I don't know anybody there. I'm not invited. I'm not going. He's like, no, you're invited. Anybody can go. It's just a bunch of guys from the floor going. I have a room. You can stay in my room. I'm like, okay. Never really had been to Vegas. I'm like, okay, cool. Let's do this. So go to Al is his name. So Al and I go into the room. There's 2 beds. Great. Okay. There's a little door in the corner of the room. Now, backdrop, the hotel doesn't exist anymore, but it was called Desert Inn. So if you happen to see the movie Rain Man with Tom Cruise.
Yeah.
Yep. Opened up to one of those suites.
Wow.
And I opened up to a Rain Man suite, and I turned around and I look at Al. I said, whose room is this? He said, it's Tom's. And I just looked at him and I said, who's Tom? So unfortunately, Al had a family emergency, so he had to leave the next day. I was stuck with Tom, and as they say, the rest is history. We just immediately bonded, and we literally have been working together ever since that day.
Wow. And that takes us back to around about the time of the 87 crash, or a few years before?
Right after, it was 88, yeah.
Right.
Yeah.
And when did you start on the floor, Scott?
I started on the floor the summer of 86 as a clerk. So it's funny because that doesn't exist anymore. The floor doesn't exist anymore, so forget clerks. But everything is going electronic. I shouldn't say the floor doesn't exist. The CBOE still does have a floor with some traders on it, but everything has really gone electronic. Yeah. So I started on the floor. My dad knew somebody that I was introduced to, went down, and I was a runner. So back then, I mean, now, we could do everything we want right here, just on our phone. But back then, that wasn't the case. So back then, if you wanted to get an order in, you had to call your broker. Funny thing, not what you would think of a broker today. Everybody has to have a broker if they're trading, not a broker, which would be a designated person who would be there to assist you and charge you a fortune. So you'd call your broker. They would then call their wire room. Their wire room would then message the floor, and then a runner, like what I was, we would run the order out to the pit. Well, I'm sure that you've heard people say, don't leg into spreads, just put your spread on, there's no reason to do it. Well, that's really the history of why you don't leg into a spread. It could take you an hour or 2 to get a fill. So imagine if it took you an hour or 2 to get a fill, you don't know what your fill's going to be, and now you try to put the other leg on, you're like, wait a minute, the market just moved, so there's absolutely no reason to do it. And today, I mean, yes, sometimes I do leg into spreads. I still think putting them on as a spread is typically better, but that was hysterical because we would laugh once I got into the pit. You would laugh and say, well, somebody would say, how long does it take for an order to get out there? And the simple answer would be, it depends if the runner ran into a cute girl along the way, because if he did, that might slow the process down a little bit.
And quite a few marriages came out of the floor as well, didn't they?
Well, I don't actually know that. I'm not sure that I know anybody that got married. I'm sure some dating. I don't know that any. I didn't meet my wife on the floor, but
right.
Maybe.
And so, what was that like? What was it? Was it showing up with with your friends and a lot of ruckus, or can you even liken it to anything nowadays?
The way that I looked at it was I literally got to go play a game for work every single day because it's literally a game of numbers. So what you will find with most options traders, and if somebody isn't an options trader, this could be an indication that they could become an options trader, a very good one. Most options traders love to play games. So you have backgammon, you have gin, some people play bridge, Scrabble. So I think the world champion bridge and Scrabble player at one time were both on the floor of the CBOE. Wow. So not chess, but chess is a big one. So options, because they're 3-dimensional, stocks are 2-dimensional, futures are 2-dimensional, options are 3-dimensional because you have puts, calls, you can be long or short. So it's a big puzzle. And if you think of it as a puzzle, and I actually should say this, I hate crossword puzzles, and I hate jigsaw puzzles because I feel like an idiot trying to do them. But I am a good backgammon player, I'm a good gin player. So what you will see there's a big correlation because it's looking at numbers. And as a floor trader, so as a retail trader, you get to pick and choose what you want to trade. So you don't really need to know what the markets are all the time because they're there for you and they're good. They're really good. Back then, as a market maker, you needed to be on top of your markets all the time because a broker would come in and say, what's the market on this? You had to be able to spit out a number quickly. Then, once you made the trade, how do you hedge it? What's your best hedge at the time? So, loved it. And the way when you walked on the floor, if it was busy, there was a roar that you felt almost like if you were on a tarmac, you were in an airport. Some airports, you actually go outside and, you got on the plane outside and you hear the engines roaring. It was that type of noise. It was awesome. But literally standing like this, elbow to elbow, shoulder to shoulder, and somebody in front of you, somebody behind you. I would say the pit that Tom and I and Tony that we were in, and JJ, we were all in the same pit. It was the OEX, the S&P 100. At its peak, probably between 350 and 400 people in the pit. I mean, chest to chest, body to body. It was a little gross, but you do what you got to do.
And there was I bet there was just the feel of the market then. Can you replicate that nowadays?
No, screen-based trading is very different. I'm not saying it's better or worse. It's just very different. You can't. If you're just sitting in front of a screen, you just can't get the emotional feel that you had as the pit, because the pit was almost, the way I would describe it, almost like an ocean with waves. You would feel it kind of doing this as, the markets were moving, prices were going up and down, and you would see orders coming in and you would feel it. And you could tell when it was going to get busy. And somebody said to me when I first started, trading on the floor was very similar to flying an airplane. I'm not a pilot, but 90% boredom and 10% fear. And it really was, probably was close to 90% boredom. You're standing there going, okay, trade will come every once in a while. But then when it would crank up, and the great thing about trading is you have no idea when all of a sudden an event's going to happen and, craziness is about to break out. Now, back when we were trading on the floor, and you think about the volatility that we have today. So, this week we've had a 180-point up day. I don't even remember what the range was, but we had a 60-point up day. Not range, just that's how far the S&P's moved. And yesterday was quiet. Back then when we were trading on the floor, 5 points, 5 S&P points, which could happen in like a second now. Yeah. There was a delayed opening. If the S&Ps were up or down more than 5 points at the open, there was a delayed opening.
Wow.
Because it was like, oh my God, they've moved $5. What do we do? Now prices were a lot lower, but still. I mean, think about where we are today. And, the world has just completely changed. Access to retail has totally changed. And, Tom and I have played a big part of that, between the two platforms that we have built, and the percent of retail volume that goes through those platforms today. It's impressive. It's a big number. It's impressive.
So let's just touch on that then. You guys leave the floor, and then what was it you felt was missing, or what was the inspiration behind Thinkorswim?
It wasn't what we thought was missing. It was what we thought was coming. So floor trading was amazing. We were early in our thought process to say that floor trading was going to go away. It eventually did go away. It just took a lot longer than what we thought. And we weren't rooting for it to go away. No. We just saw the writing on the wall was that technology was going to, again, these didn't exist when we started, but technology was going to progress to the point where, people could do this on a screen. So we didn't create online trading, we changed it dramatically, and we enhanced it, and we brought it really to a level for mass retail traders. There were other firms out there doing it. We just took it to another level. So when we started Thinkorswim, we launched in late 2000, and it's funny because the internet was still in its infancy back then. And people were looking at us like, what are you guys doing? And I think part of it was a little bit of ignorance and a lot of confidence. We're like, we could do this. So we didn't really know what we were doing, but we're like, we could do this. We could build this. So our first hire, Woody Ma, he was our first hire, and he became our CTO at Thinkorswim, and then he was our CTO here at Tasty, and he retired about 1.5 years ago. But just an amazing guy, and what a fabulous team member, and he was integral with both platforms.
So let's go back to that, right? And knowing what you guys know now, what would you tell yourself as you're building that business?
Originally,
Yeah.
you got a lot to learn.
Much more than you think.
You'll have a lot to learn. It's funny because when we did it, the original concept for Thinkorswim was not even a brokerage firm, and we quickly pivoted. So, one of the items that I talk about, and I get asked this question a lot, how do you do it? What do you do? Most people, if you walk around and talk to all your friends, you say, do you have any ideas for a business? Almost everybody's going to say, oh, I got this great idea for a business. Okay. The problem is most people don't know how to put one foot in front of the other, and most people are afraid to take the risk. They're afraid to fail. And my comment about that is don't be afraid to fail, especially if you're young. If you are young, you have your whole career ahead of you. Obviously, as we get older, we have to be careful about our risk because our time horizon is shorter to recover from that. But in the beginning, when you're young, just take as much risk as you can take. Now, everybody has a different definition of risk. I have a huge tolerance for risk. Others don't. So you have to find your sweet spot. But if you have an idea, take a shot. If you can do it while working another job, you do it on nights and weekends, try it that way. But if you're fortunate enough to be able to just dive in and go headfirst into the pool and say, we're going to do this, find some great partners, people that you have tremendous confidence in that have very different skill sets. Tom and I have very different skill sets. And I think that's part of what has allowed us to be, really, really good partners for 37 years.
So you're a people person.
Yeah, I am. So, yeah. So you said it, not me, but yeah, I'm the people person. So when somebody needs something, they come to me. Donnie Roberts, who is one of our OGs, when we originally left, Tom and I, when we originally left Thinkorswim, the original 20 people got together for a dinner, and they went around and they interviewed everybody. Hey, you want to say something to Tom and Scott? And Donnie's line is the one that stuck with me, which was, if you want an answer, go to Tom. If you want the truth, go to Scott.
Oh, fantastic.
So,
and you guys working together so closely. What is it that keeps that relationship so strong? Is it the bonding that took place during the floor?
Yeah, well, that's so I'm a believer that we are all a product of experiences, whatever our experiences are. We've just built off of our own experiences. Tom and I have had a lot of experiences together. But at the core, we are very similar in our beliefs. Operationally, we're very different, but we have mad respect for each other. We have tremendous confidence in each other. So we don't ever need to speak because we just know we're going to go do what we both need to do. But we do talk a lot, and we talk often. So, he's doing his thing, I'm doing my thing, JJ's doing his thing. It's a reason JJ's been great because the same thing with Tony, although Tony, I don't interact with Tony the same way because I do on air, but not really from a business sense. He's not on the brokerage side. JJ crosses over. Tom crosses over a little bit, although I do have a letter that he had to sign for FINRA saying he wouldn't be involved on the brokerage side. So every once in a while I get to pull that card out and say, you got to leave.
Back off.
Back off. Don't make me pull the letter. So, but it's just a tremendous amount of confidence in each other's abilities and, just respect and trust.
Can you remember a especially pivotal moment in either of the businesses, whether, maybe it's a mistake that you would go back and do something differently or a success?
Well, we almost went out of business let's see, let me think of what year this was. 4 or 5. Google. We had I have to go back and look at a chart in this. I try to put this out of my mind.
Well, the Google IPO was 04 because that was my first day on the New York Stock Exchange.
Google IPO was 04, so then it was probably 05. So we had a huge customer for us at the time. It was ginormous. This person came over from Morgan Stanley. They had a trader on the account who was they had an LTA. The trader was on the account. The trader had a huge position in Google. Long options. And at the end of the day, I think long like a 600 lot of the 280 puts and a 4,700 lot of the 280 calls.
Wow.
Now, back then, automatic exercise was 25 cents. So today it's a penny. So if your option's a penny or more, it's automatic. Back then it was 25 cents. Years ago it was 75 cents, which is crazy. Think about an option was 74 cents in the money, and you didn't know about it. A market maker just got to walk away with a free, 74, right? It's crazy. So the stock was under 280 right up to the close, because we were trying to buy stock for him to do this, for the trader to do this. Stock was under the whole time, but we couldn't buy stock. It was under, but not by a lot. It just didn't really make sense to buy stock. It was right there. Okay, that's it. End of the day, we just put a DNE, so a do not exercise in on the puts, because there wasn't enough there. The customer didn't want to do it. He's like, don't worry about it.
Okay.
Monday morning, Tom calls me. I hadn't gotten to work yet, and he said, "Are you aware of what happened?" And I said, "What are you talking about?"
It's never a great way to start the conversation.
No, the OCC, which is the Options Clearing Corporation, they are the judge, jury, and executioner for settlement. They picked a closing price of 280.35. Now, time and sales. I have a sheet. I have stacks of papers, probably for the last 2-3 minutes. That's how many trades were going on in Google. Every single print was under 280. Except this one print was 280.35. That's what they went with. Apex are clearing, well, at the time it was a different name, Penson, but they didn't call us. The OCC doesn't catch this. They put it through. So do the math. It was 460,000 shares.
Yeah.
And I don't have to tell you the stock was $6-7 lower at the time. And so I call the customer, can you send in all this money? No, I can't. Okay. We start liquidating. We sold it. We liquidated it all before the open. We lost $7. We lost $7 on the trade. And, if that would have gone down probably another 10, it was a low print ever in Google. That was the absolute low print. If somebody would have just hit us over the head and, woken us up like a month later, it would have been ginormous.
Or 15 years later.
Yeah, 15 years later would have been even better. It was a low print. It was the low day for us. And if it was down another $10, we were done. We were out of business.
It's amazing how many successful entrepreneurs have that kind of story, isn't it?
Yeah, it's nothing goes straight up. Nothing. And for me, obviously, I love the successes. I'm not going to say I don't. The successes are a lot of fun, but I focus more on, my brain goes to what are the gotcha moments? What am I missing? Especially when things are looking really good. What am I missing? There's a train about to come down the track that's going to run us over. Where's that train coming from? Yeah. But this was one that was just completely out of our control. We had another one, which I'm sure Tom has told you about, where our developer, the company that we're using, the developers originally to build Thinkorswim, they had a falling out with their business side. The business side was in New York. The developers at the time were in Russia. Tom called the business side. They said, we can't support you. You need to go with the developers, which we did. Mm-hmm. Tom will deny this, but he knows it's true. We owed them, we were paying $25,000 a month. That's what our minimum was. And I said, just pay them the $25,000. We owed them 2 months. Pay them the $50,000 and be done. He's like, why would I pay them? They can't facilitate us. I said, because then we've completed our contract and there's no issues. And he's like, I'm not doing it. I'm saving us the $50,000. I'd say about a year and a half later, he walks over to me and says, aren't you going to thank me for saving the $50,000? I am not kidding you. I think that day or the next day, we get a lawsuit. They sued us. We had 11 or 12 people that got up and told the truth. They had one person that got up and lied. We lost $4 million.
Welcome back to the show. Welcome back to Talking the Shop. It's good to have you with us. I'm Luke Moore. I'm your host for the next 30-40 minutes, and I'm joined by my glamorous assistant, Mr. Ronnie Agnig. For the second time this morning, we're coming out on the show live. So if you're live, welcome. If you're listening to this back, you've got to join us on the show. We're starting to do these Talking Shop episodes now every other week live on the show. So you can join us, you can like, you can subscribe, and you can join us on the chat. So welcome to you here. Ronnie, how are you, bud? What's going on?
It's brilliant. Yeah, we were just sitting here before the cameras were rolling, talking about me coming up to my 1-year anniversary here. Look how far we've come, mate.
1 year. I actually can't believe that. It's gone so quickly.
Yeah, I mean, I definitely didn't change my whole style after to model you after I started on the desk, but it's cool to be here waffling on. It's nice because we talk about all these things off camera as well. Yeah. So now we're doing it in front of the people, sharing our knowledge.
Yeah, well, we've long been thinking about how we get both me and Ronnie on the camera at the same time, right? My surname's Moore. Moron show. We've been kind of playing around with that to see if that's going to work. But we're technically the talking kind of podcast today because we've got no S. Sean's not here.
No.
We've got no P because Pete's not here. So it's just the morons today.
It's the moron talking shops. Yeah, I mean.
1 year though. That's a long time.
1 year. We've come a long way.
Yeah.
Started off confused, didn't know my bids from my offers. And now look at us.
Now we got.
Who would have thought?
The high top fade, the navy jumpers, the sweep of the hair to the left. Yeah,
I definitely don't ask Luke for advice for every date that I go to on where I should take them. Definitely not.
Just in case any person that he's dated in the last. I'm not going to say anything. No, but,
let's move on. Let's move on.
If there's any nice venues that are up and down, London, Mayfair, Soho, anywhere like that, you may find a Ronnie sat there in the bar.
Hey, I'm just spreading the knowledge. I'm pitching IG to them.
This is it. Well, that's a nice little carry into what we're going to talk about today, actually. Look at that.
What do we have on the agenda today?
On the agenda. So I think what we wanted to talk about, and it's something that clients always speak to us about, and I think the logic gets bounded around. It's very easy for people to say about this. So we're going to try and tackle the subject of stop losses. So everybody talks about stops. Should you set them? Should you not? We have clients that do, clients that don't. What scenario should you? Is there a model you could follow? And for those that have been following the Talking Shop series, we've spent this year in a bit of a trade craft kind of educational mode. And we're going to return to that today. So we're going to try and break down stop losses. So welcome to the episode on stop losses. So Ronnie, why don't you kick us off? In your words, for those that don't know or don't use them, what is a stop mechanically? What is it? How does it work? What is a stop?
Yeah, so for me, it's quite simple. Like it was one of the first things that we learned when we started IG. So a stop is a way to sort of stop the bleeding, as I like to say it. It's a way to limit your loss. You basically put in a level where you wish for a market order to be triggered. Mm-hmm. So you put a stop level and say, at this point, I no longer want to be in this position. Get me out of it. And that's the main purpose of it. It's very simple in the sense, but it's super effective in a way that you can manage your risk and limit your downside.
I think that's really important, you say there. Stop is a market order with a trigger level. That's by definition, if you look on an exchange and you go to the CME, you go to the LSE, a stop order is a market order with a trigger level. So just to clarify, a market order is an instruction that says to the exchange, says to the market, I want to buy or sell at whatever the prevailing price is in my size. And I don't care what the price I get, I just want to pay market. So if you've got, Lloyd shares which are breaking out above 74p this week, if you want to go and buy some, you just say, I want to buy 200 shares of Lloyd's at market, and you might get filled at 74.01. That's just how that works.
Yep.
So having that trigger point to become a market order is really important because it brings in this subject of what we call slippage.
Exactly, yeah.
So if you were to put your stop on, let's just say the market, let's just say the FTSE trading at 7400, if you put a 10-point stop at 73.90, you may get filled at 73.89 as a result. And that is normal, that is expected. Now, with IG, if the market trades at your stop level and it's in a reasonable size, we're going to fill you at your stop level. But it's not always guaranteed. Markets can gap.
Yeah.
A really good example of this is the weekend.
100%.
What was it, 2 or 3 weeks ago when everything was completely crashing down, the markets opened 4 or 5% lower.
Yeah.
If you had just stop in between those levels, there's no trade at that price level. There's a gap.
So what we do is we then use our system at IG to fill clients at the best possible price near the open. So slippage is a thing. We've got to acknowledge it. Stops won't always execute at your requested level, but there's a good thing with us is you can ensure your stop loss. So you can use what we call a guaranteed stop loss. So guaranteed, you know, on the FTSE, it's going to charge you an extra point in premium, like you would pay to an insurance broker. With us, on the NASDAQ, I think it's 2 points, and we'll ask for a minimum distance of, say, 1% or something like that. So there are ways where you can protect yourself against slippage, but it's really key. It's a market order with a trigger level.
Yeah, it's sort of, if you look at it, compare it to a limit order. So with a stop order, your priority is speed of execution, right? You just say, just get me out of this at whatever price. When it hits this, get me out, right? It's speed that's the priority. When you work in a limit order, it's the price that's the priority. So you're willing to wait a bit longer to be filled at that specific level. So that's the sort of key differentiation that's important to keep track of. And like you said, with the guaranteed stops, they cost a bit more, yes. There's a premium that's added and it's triggered if the stop level is reached. However, you can also have to take the consideration in what if it gets slipped, sort of in a very, very volatile market. Now, more often than not, you will get executed, best execution and will be triggered according to your stop. But like we've seen in the recent times, markets gap, and if there's no price in the market, we can't close you out. That's where we go to the second best price and there can be a slippage, but we'll take that cost on if you have a guaranteed stop.
Yeah. Now be honest, how often do you use stops?
The first time I used stops on my demo account, of course, the first time I used stops on my demo account was when the whole tariff thing kicked off. And I made, a pretty decent return on my demo. And I said, you know what, I'm not going to give all the gains away. I put a stop in. I think to lose, max loss was 500 or something like that, which is insane because I had 2,500 in my account. So I needed to listen to this podcast before that. But yeah, it got triggered. And I was like, oh man, I swear it's going to come back. It didn't. It went down. If I would have stayed in it, I would have lost the whole balance on the account. Yeah, so it sucks when it's triggered, but you may not realize. It's like your parents. When your parents forbid you to do something, you may not realize it now, but it's for your own good.
Yeah, Mango, look, I completely agree with you to kind of look at a comment on the chat at the moment. Stop orders are a must. Now, it's very easy to say that. It's very difficult to implement it. I've had both sides. So I've had times when I've not used them and it's worked. I've had times when I've not used them and it's really not worked. Yeah. I've had times where I've used them and I've been stopped out at the turn, and I've had times when I've been stopped out and it's worked really, really well. It's trying to get the balance right. And I think this year when I've been personally trading, I took something out of Axel's book, and losing money doesn't mean you're wrong. Losing money in a managed way means you're following your process, and that's actually a good thing. Yeah. And that was what Axel said. He said last year he set himself the target not to make money, not to lose money, but to really follow a process. And he said that he went through the whole year having followed that process, and that meant he'd planned for his losses. It meant that he'd planned for his P&L, and that was fine. And that's the really interesting bit. But using a stop to control a loss doesn't mean you're wrong. I think this is really important. If you use a stop, you're right, and you're controlling your risk at the point of putting it on. 100%. You can't tell the future.
No one can. I mean, if we could tell the future, we wouldn't be sitting here. We would be sitting on a beach somewhere doing whatnot, click, and away. But I think that's key. What you say is that you're not wrong. You're right about the risk, and you manage it correctly, because we all know there's risk involved in trading, and there's a lot of risk involved, especially with leveraged, derivatives trading. It can swing so much. So if you're not having that sort of process in place where you're protecting yourself, you're only opening yourself up to further damage. I mean, we've seen accounts with clients who refuse to put stops on, and it just keeps going because they think it's going to turn, and then it ends up, eating up their entire equity, that running loss. So having a stop in place, it's vital, not only for you to be able to free up your capital to do other trades, because you're not going to get every trade right, but you need to make sure that you have the exposure correct for every trade.
Yeah, I completely agree with you. I mean, in the 11 years I've been doing this job, I'm going to say that it's such a small percentage of my clients that genuinely use a stop in every single trade. I'll tell you a story. There's a client I used to look after who had a strategy where, and I think I've said this on the show before on live, you really lean into the technicals. And I think when you use stops and you use stops correctly, you're really just letting the price action do the talking for you. Yeah. And he would put on a tiny trade with a very fixed stop. So he'd call it his pilot trade, right? And so he was a trend following trader on the DAX. And so he'd put the pilot trade on. If the market moved higher, he would then add to that. But what he would do is he would move his average stop up. And then if he got stopped out, the average P&L between the two trades was at his break even, and then he would reload and go again. And so it's a strategy that continually allowed stops to dictate his risk, because you can't tell what's going to happen in the future. No. You just can't. You know, I don't know if the FTSE is going to go up, whether it's going to go down, or I have no idea. What I can do is I can say to my account, you can afford this much risk. I don't want to take on more than 2 to 3% of my account's risk at times. So therefore, I'm going to put a stop loss on. If I do, I lose it, but I've got 50 swipes at it if I'm using 2% risk. And obviously you would change your position sizing, which we've already spoken about.
Yeah, flip a coin 50 times, eventually you'll get it right.
Yeah, exactly. Look, and Mango, you're so right again. And if there's anyone else in the chat, please do jump on. Think about the market right now. How much headline risk exists right now? I mean, I'm sending texts out to my clients all the time. You know, there's a Trump truth here. China have said this. You know, the UK is doing this, and there is so much headline risk, and you can't control what you can't control. It's very stoic.
Yeah, I mean, that's the thing. You can't control those sort of factors, but what you can do is you can control your reaction to it. Right? How you react to it and how you manage it. I mean, we were all sort of during this whole season, you know, liberation season that we've had. I think everyone's just been sitting with like one screen dedicated to sort of Twitter, Reuters, Bloomberg, and just like refreshing to see what's coming up, because each time something comes up, it either spikes or it bottoms. And then you're thinking, who can take this? Like, it's not a lot of accounts. Like Mango says, if your account can hold spikes, good. But not a lot of accounts can hold a massive spike or a drop. So having that in place, just protecting yourself, being ready is always good. But out of curiosity, you've done this for a long time, 10 years more than me. What's the sort of main excuse/reason that you hear from clients for not using a stop loss?
Oh, the one that always gets me is I'm going to hedge. And so you run a long short. Yeah. I'm hedging.
So you make no money regardless.
Yeah, you're effectively taking the exposure off by having a long position and a short position at the same time. You're paying your broker fees to have no risk. Yeah. So I don't get that one. Super low edge. The other one, the one that I get the most is a mental stop loss.
Oh no, the
mental stop loss means that you're never holding yourself to account on where you're going to take the position off. And we see it time and time again. It's an interesting observation between those that are considered investors and those that are considered traders. And I think you're an investor if you're looking out any further than 6 months at a time. Anything lower than 6 months, you're looking at swing trading month to month, week to week, scalp trading daily, day trading. And when you reduce your time period, you introduce more randomness, way more randomness. Yeah. So you go longer term trends, you're gonna hopefully smooth all of that out, which is actually one of the methods that we're going to talk about. But it's this mental stop loss that I've got real umbrage with, because
I've never actually had someone who triggered a mental stop loss.
Okay, how many times have you? I'll give you a practical example. How many times have you had a bad day at work and gone, I'm going to go to the gym, and then don't go to the gym?
I'm the wrong person to ask because I go in the morning.
You're a before gym guy.
Yeah, but I'll tell you this. What I often used to do when I was in sort of like uni or whatever, and I was taking my breaks, my study breaks, and I would sit there and like doom scroll and whatnot. Yeah. And I would say like, okay, when clock hits 35, I'll start studying. Oh, it hit 36. I might as well wait to 40. You know, and I think that's the same sort of principle. Oh, you know what? It's already too late now. Might as well just hold a little bit more, and then it's going to come back. Yeah. And that's a lot. One thing that I hear a lot about from my clients when I try to talk to them about risk management and exposure and that sort of things is they say, oh, but as soon as I put a stop, well, every time I hit a stop loss, it just hits it and then bounces back. Mm-hmm. All right, but then your stop loss is too tight.
Yeah. Yeah, it's too tight. And the problem is it then compounds down the pain because you go, oh, well, it's just bounced. It's moved off me, so I'm not going to use it again.
Yeah.
I mean, there were some studies that we did and there's plenty of articles on our website to look at this, but we think there's around 60% of our retail clients don't use stops or don't use them consistently. 60%. And you know, as part of that same study, we saw that you can reduce the average loss size by about 25%.
Yeah, I mean,
and that's really material. If you think about, you know, we're talking a lot about interest rates on our ISAs at the moment. That's 4.25% per year, right? If you're not factoring that into your plan, this is the potential error rate that we see of people not using stops is like 4 or 5 times the base rate of interest. You may as well just put your money in the bank, leave it in cash, and just not bother. Because your error rate, the cost of you not using stops is way higher than, you know, the base rate of return. It's mental.
Yeah.
We're nattering on. We're going to introduce some strategies now.
Oh.
So you know,
here for the good stuff.
We're here for the good stuff, right? We're not just here to talk about our experiences. We actually want to give you something to go away and work on. Volatility. So you can use the fixed stop, okay? You can use a fixed stop, targeting 2 to 1, 3 to 1, 4 to 1. I think we were looking and doing some research. I think Paul Tudor-Jones said he uses 8 to 1. No, sorry, it's Mark Minervini uses kind of an 8% rule, so therefore he has to try and target 16 to 24%. So he's much more longer term. Paul Tudor-Jones broke down that, you know, he has to work on at least a 4 to 1 risk reward, otherwise he doesn't take the shot. So if you work on a fixed risk versus reward, that's what we start to talk about. Yeah. But we're going to introduce something called the average true range. Now, have you got the definition on your phone, like we asked you to?
I do indeed have the definition.
So what we want to do with introducing a concept like ATR, I want to give you something that you can take away and do some learning on. So the average true range is a statistical model that works across all asset classes, FX, indices, stocks, whatever you want to look at the volatility on that market over a specific amount of time. So Ronnie, hit us with the definition, my friend.
All right, here we go. Average true range indicator definition. The average true range, also known as the ATR, is a technical analysis indicator that measures market volatility by calculating the average range between high and low prices over a specified period, typically 14 days. It was developed by Pop Quiz.
Kaufman.
Close enough. J. Wallace Wilder Jr. and is widely used to assess how much an asset's price fluctuates without indicating price direction. Happy with that definition?
I'm happy enough. I'm happy
enough. Continue?
If you've got more, hit us.
Okay, I got some key points here as well.
I want to know.
For the people.
Yeah, I want to know. For the
people, okay. Key points. The purpose of it. ATR quantifies volatility, helping traders manage risk, set stop loss levels, and determine position sizing. Calculation. The ATR is the moving average, usually a 14-day period, of the true range, which is the greatest of current highs minus current lows, absolute value of current highs minus previous close, absolute value of current low minus previous close, and interpretation. High ATR equals high volatility, large price swings. Low ATR, low volatility.
Yeah. Well done.
Thank you, sir.
You can read.
I can indeed read.
You can read. I think what it breaks down into is there's loads of different ways to measure volatility, right? People talk about the volatility index, the VIX, the Euro VIX, which is specifically around equities, specifically around the S&P and the Euro stocks. So not always the cleanest to look at every different multiple asset class. But what it does is it gives you a view of basically the highest high and the lowest low and takes the average range over your X amount of days.
Right.
Okay, that's probably the simple definition. Now, model number 1, there is a volatility-based stop-loss model, okay, championed by Dr. Elder in his book, Come Into My Trading Room in 2002. And he proposes that you take the ATR on a 14-day period,
yep,
and you apply some form of multiplier to it. And that's how you set your stop. So if you look at a 2 or 3 ATR model, what you're basically saying is across the previous 14 days, and of course you can tweak all of the criteria, over the previous 14 days, and I'll give you an example. We looked just before we came in the room, the 14-day ATR on cable at the moment is 92 points. Let's call it 90 points just for round numbers. And you're going to take a 3 times multiplier on the ATR. 3 times 90 is 260.
Oh, you okay? Sorry, I was just.
Is that right? 180. Yeah, 90, 180, 260. Yeah. 270.
Damage is already done, mate. Cat's out the bag.
Sorry.
Cat's out
Sorry.
the bag.
Yeah, so hang on, 90, 180. Yeah, 270. Come on. Anyway, so you've got a 200.
I can read, but he.
I can't count. So you've got a 270 point stop distance is the way that that model would work.
Okay, so Luke, let's say I'm a novice trader. I've
Yep.
never heard of ATR, none of this. I'm sitting in front of my computer now. I've got the IG platform. Practically, how can I implement this?
It's almost as if we set that question up. You're very, very scripted about it. So you'd launch a chart,
Yeah.
first and foremost. You'd right-click, you go to Indicators, and you click on Average True Range. And what happens is it pops up at the bottom of the screen. And it will range, of course, if you're looking over the 14 days,
Yeah.
it's going to give you a change in the high and the low, and you're going to be able to vary.
That's the recommended range.
Very
14
easy.
days.
Yeah, and I'd definitely go away and I'd add some more research, look at ATR, volatility pricing models. But the generally accepted is use 14 days, and you maybe use a 2 to 3 multiplier. Now, we've already gone through processes where you use stop distance and your account size to determine your position size. So we've already spoken about that. But if we've got that in the place, what you need to happen is a significant move outside of the previous range of the 2 weeks, and you're giving yourself 3 times that to help. So, Dr. Elder says that they use 2 ATR for swing trades and 3 ATR for positions that are over a month. So you try and give yourself that breathing space, right? What are the risks? Well, you get stopped out less, okay? You get stopped out less, it means you're going to probably run trades for longer, which might not suit your appetite. You might want to be a bit shorter term, in which case maybe tighten it up to 1 ATR. But if we're saying the range over the last 14 days, you introduce the chance of maybe getting stopped out prematurely. So I think it gives you that breathing space.
Yeah, and that's what Arthur Fox Haig is commenting, writing in the comments. There's limiting the size of the losses versus the frequency of taking the loss. So if you want to set yourself a 2% distance, then yeah, you'll probably have a bit higher frequency of getting stopped out. You'll take on smaller risk in terms of notional, but you'll also increase the likelihood and the frequency of getting hit. So if you're looking to say, like, I don't want to hold positions for too long, then 2% is probably the way to go. But if you're saying, you know what, I don't have anything against holding this position for a bit longer, then give yourself some breathing room and do this sort of 5 to 8%.
Yeah. So we're happy with the volatility ATR model?
Yes. And just a question, asking for a friend, of course. Is this applicable to just equities, or can I use this for all asset classes?
You can use it for all asset classes. And that's the beauty of it, because it's a model that's based on the range of that specific asset class at that time. Then you can apply it to all. The one thing I would be cautious of is when markets close.
Yes.
So I don't personally like holding risk over the weekend.
Though I don't.
But then you run the risk of cutting positions that could work out profitably in the long run. But I don't like the fact that you can see gaps at the weekend, especially at the moment. So I try and close off my book by the weekend, unless you want to guarantee it. So you can still use this logic and then allocate a guaranteed stop over the weekend. That's something to consider, for sure.
Yeah, that's something you can do, but it's also, it's nice to go into the weekend without having that at the back of your mind.
Oh, yeah. It's one of the coaches I spoke to before was like, no one does their nuts on a Friday.
That's what I've been saying, man.
Never do your nuts on a Friday. It's just not worth it. It ruins the weekend.
I know 100% what that means.
Right, let's go on. Let's advance this, right? So we're happy with using ATR. We've already discussed what that is.
Yeah.
There's an advanced model that can sit on top of this.
Okay, and it has a very fancy name to it as well. It's the chandelier exit strategy.
Correct. Yeah.
So we talked about the volatility-based stop loss model with the ATR, and then the chandelier exit strategy. I'm not reading from my notes here. I'm just nervous, can't look at Luke, so that's why I'm looking down. Developed by Chuck LeBeau, this trading stop method has shown a 15 to 20% improvement in average trade profitability compared to fixed stops in back-tested futures markets, according to research by David Aronson in evidence-based technical analysis that was released in 2006.
Yeah. It's interesting because it just takes this ATR logic and applies it to the highest high for long positions or the lowest low for short positions. Marvin, I've seen your question. There's a question on the chat here about stop losses and options. We're going to come to that in just a second because I agree with you. The comment is, I don't think stop losses work for options trading. If you've got a defined risk strategy, they don't work, of course. That's the whole point of defined risk. But we're going to come on to that because there's another thing that we're going to discuss.
It's almost like you listened to us when we were prepping this podcast.
Yeah, correct. And Paul, your point on the guaranteed stop, the question is, a guaranteed stop will move massively over the weekend. It does, but what we do is, because we are the insurer, and we've already discussed how slippage works in the real world, we increase the minimum distance. And so it's always going to be after the European close, before 10 o'clock on a Friday, somewhere between kind of 5 and 6 o'clock is when we'll make that change. So if you've got your trades planned out ahead of the weekend, just be aware that that's when that's going to kind of change. But back to the chandelier. Yeah, the point is, if we're using the volatility ATR model that we've already discussed about, this time, hang it from the chandelier. So we've already figured out that a 3 ATR on cablings at the moment is 90 points to 270, three times the multiplier. But let's say the recent high on cable is 135. So instead of taking it from your entry, you take the 260 points, 270 points off the highest high.
So what I'm doing is, instead of actually going, this is where I entered, and then I will place my stop in accordance to this, I will instead place my stop in accordance to market movements and the highest and the low.
Correct. Yeah. So this works best in a trending market.
Right.
Because
so if you're a trend trader, you're following that. It's a good.
But think about it, right? If you're in a trending market and the market is going higher, this is almost a trailing stop kind of thought process. Because if you're moving higher and you want to effectively be maintaining a 3x ATR distance, the chandelier model allows you to move that up and follow the market as it moves higher. And of course, if the ATR changes, you can make amendments to your stop loss, you can increase it, you can decrease it, as long as it fits your risk parameters. You may want to change the position size if you're moving it wider. But it's really interesting because the research behind this that Lebeau put through said that they analysed 10,000 trades and they found that the strategy retained an average of 78% of the trailed moves. So therefore, it was continuing to keep trades in place because it would allow you to trail your stop higher, compared to just 59% for fixed stops.
So yeah, so it's basically sort of taking the regular trailing stop and it's making a bit more advanced with the entry level, but you can effectively do this with a trailing stop as well. But it's interesting because what you do is, we had a nice quote here that I wanted to bring up in relation to this. Anyhow, what I wanted to say, here we go. And this ties well into this beautiful quote by John Bollinger. Stop should expand and contract with market volatility. Rigid stop distances fail to adapt to changing market conditions.
Yep.
And that's exactly what this is, right? Market moves up, you move with it. So you're effectively changing your exposure and you're changing your risk as the market does. So you're no longer set at that same stop level because you're adapting.
Yeah. Yeah.
So I think that's really, really a smart way to go about it. It's a brilliant tactic to use when you're sort of buying the dip, right?
Completely. But I think the point through all of this is it's okay to move your stop in the direction of the trend if your trade is working.
Yeah.
But it's never okay to move your stop if the trade isn't working. Yeah. Because then you get back into this mental stop loss thing where you cannot overestimate the impact of loss aversion when it comes to trading. I think it's one of the biggest psychological factors that we have, right? 100%. If you lose money in any other walk of life, you're considered to be wrong, right? You start your own business, the business fails, unfortunately. You're wrong, you did something wrong. Whereas in trading, losses are part and parcel of how it works. You're never going to shoot every single trade and make 100% winners. It's just not going to happen. Some of the best traders run on 30-40%. So the majority of your trades are going to be losers anyway. So therefore, it's about managing those losses. So if you can find a model that allows you to scale based on market conditions, optimized for position sizing, you're going to be giving yourself much more of a chance of success than the next person.
It's like we've talked so often about this show. It's when the facts change, so should your strategy.
Correct.
Right?
Yeah. And I find it. What do you think about stops on stocks versus stops on like an index or an FX pair?
Stops on stocks, I think they're a bit more. I think they're a bit more necessary. You know, I would rather go on guaranteed stop with a stock because the risk is so much larger, right? You're exposed to the headline risk for that one stock, whatever it can be. So it's very specific to that one. But with an index, it's obviously so many other factors that come into place. It's macro, it's several other companies. So with an index, I like to use a stop if I'm doing the sort of intraday trading or similar. Like, it's not like I have a stop loss on my S&P 500 ETF that I have in my ISA.
Yeah.
I don't have a stop there. But if I'm doing, you know, in and out, then I'll have a stop on that. But I can be a bit more flexible with it.
Yeah, I find it more difficult on stocks just because I get wedded to the stories. I know it's a blind spot for me because I want to know, you know, there was that space-based trust that we were talking about. SSIT, yeah, Seraphim Space Investment Trust, something that we were talking about. You know, it's the story around it's really interesting. It does everything around the space economy that isn't SpaceX, and of course, you know, we think under the Trump administration that's going to be quite good. Roddy and I were talking about it. I've now read so much into it. I feel like I've done the research, so I feel like it owes me, which is ridiculous, which obviously doesn't owe me anything. But I feel like because I've spent some time looking at it, therefore, I can't stop myself out because
Guys,
it's going to go
why can't you see what I'm seeing?
Ridiculous. I'm going to move us on to the third model, and this one's interesting, and this is something that we've already spoken about. Arthur, I like your comment, by the way. And I've got a rule to never open a brown envelope on a Friday unless oh, blimey, my voice went. Never open a brown envelope on a Friday unless you can't do anything till the Monday. Yeah, that's good until the bills. My bills for my service charge on my flat is now coming in a white envelope. So
what's a brown envelope?
Bills. Bills typically come in a brown envelope.
Right, yeah.
So you don't want to open a bill or something that you don't want to look at.
Okay.
You don't want to ruin your weekend. You don't want to see it.
That's true.
You don't want to do it. Options are really interesting. Options are something that we've launched in the last year via the Tasty platform last summer. We've always had OTC options, FX indices. But what we've been doing a little bit more thought into, and this was a conversation I had over a beer with a client fairly recently, was about how to use options as a way to use your stock. Now, the obvious one is if you're long the market, you buy a put. Yeah. So if you're long the market and the price comes down, the expectation is the put strike level becomes your stop loss. As the market goes lower, goes through your put strike, therefore your put becomes more valuable. As long as you get the sizing correct, you lose on the directional stock, underlying index, whatever it might be, and your put profit offsets the losses. So therefore, you're neutralizing the P&L at the put strike. You've got to take into consideration the premium, but that's a sensible way. Why that works nicely is if the market then bounces back up again, your put devalues back to zero, your insurance has worked, but then of course you're still in the trade to benefit from the upside. Now, that's fine, it works, it makes a lot of sense. It's quite expensive because you're hoping that your insurance isn't required. Yeah. So you're going to lose the premiums every single time, and you're working on a time horizon, monthly, quarterly, whichever way you're going to do it. What I think is really interesting, and something that I don't have any research on, but I think is a really interesting thought topic, is using the expected move on an option.
Which you can see on the Tasty platform.
Which you can see on the Tasty platform in order to define stops. So one of the big things that you can use options for is you can roughly figure out the odds of something happening by looking at the delta. Now, it's not mathematically equivalent, it's an approximation, but something that the Tasty platform will give you is the delta, and it will give you the expected move. And the expected move always sits roughly kind of 17 to 20 delta. And when I say that, I'm starting to use some more technical language here. If you were to look at any market, let's just say the FTSE again, and there was a series of options that could tell you mathematically what the odds were of the FTSE being higher or lower than a price by a specific time, well, that's a pretty cool way to set a stop, right? Because now all of a sudden you go, well, okay, I'm looking at the expected move over the next 3 months, and there is a 20% chance it crashes back to 6,000, okay? I haven't checked those numbers, I'm just making it up off the top of my head. But isn't that quite a clever way to start to set stops? I would take an 80% shot at that if you know that it's only a 20% chance it's going to go below 6,000.
I like it because effectively what you're doing is you're using this, you get the same effect of a stop, meaning you limit your downside, but you're not taking the exposure off, right? Because you still have that put, you'll profit of either one of those. So you're taking your exposure off, so you can, if it comes back, you'll make money there, but you're just hedging yourself rather than taking yourself out of the position. So I quite like it. It's obviously more complex and more costly to execute, but it's something that's quite well adopted by the sort of hedge funds and other sort of more sophisticated traders in that sense.
I wouldn't say it's more expensive, because what we're saying is, if you were to set your stop where you know the 15 to 20 delta options are within a time period, you just set a normal non-guaranteed stop on the IG platform. So you take a look at those stocks, you see where the number is, you flick back onto your main portfolio and you say, right, this is where I'm going to set this stop because I know what that data is. And you know what goes into that calculation for the expected move is time, is volatility, and also includes, you know, expected catalysts between now and then. Option pricing is some of the most mathematically accurate prices in the market. So if you know that you're taking a shot and maybe at a 10 delta, there's only a 10% chance that it's going to go down or up, it starts to become a little bit more interesting. Especially when you then think about maybe, okay, well, I'm going to protect my downside by buying a tiny put, perhaps. If you buy like a 5 delta put, there's only a 5% chance you're going to need it. It therefore isn't going to be that expensive. You maybe look at that as an option. I think it warrants more thought. I think it warrants more thought as a way to kind of marry the world of exchange traded options over here and the shorter term trading that we do on our OTC platform.
Yeah, it's a great way to get the sort of exposure out of both ones and sort of limit your downside, but also not limiting your upside.
Yeah. And to take some questions, we are. I think there's one in here. So RSAX, does IG provide VWAP or TVOP? I don't know what, I think that's time weighted price. So the IG charts do have a VWAP function. So you can add volume weighted average price. So you can have a look at that. There is an article on the website you can take a little look at. Blake 7, do we do options on London stocks? Yes and no. So yes, you can broker them. They're pretty horrible markets, though. I'll be very honest. The spreads are really pretty ugly. So we don't make them on the platform, but you can give us a ring. So if you want to know where, you know, the Vodafone 60 puts are, for example, you can give us a ring. We can get you a price, and we can broker that for you. We'll then book it to your Spreadbet or your CFD account. And Arthur, your point on the insane margin requirements on spreads, I agree with you. I think our options desk agree with you. It's a matter of trying to change. There's something very fundamental in the way that our Spreadbet and CFD margin engine works. That it's a bigger job than you might think. If you want the most accurate margins for spreads, we can look after that on the Tasty platform. So the Tasty US futures options, we can do that very, very well. But for the OTC stuff that you can trade in Spreadbets and CFDs, we don't have that yet. We're hoping to. I don't have an ETA. So yeah, there's plenty. So should we wrap up there? What do we want to do? So we've spoken about what a stop fundamentally is.
I've had a lovely chat so far. I don't want to. Okay.
Ronnie's just come back off of, you know, a 10-day holiday, looking flash.
Yeah, man.
You come back in. You've been on TV this morning, and now you've been here talking to us for a while.
Yeah, I got hit with some messages from Luke, like, oh, you're on TV tomorrow, and then after that you're doing the podcast. And I said, great. I'm so happy. I really took a break from the markets and didn't read up on anything while gone. But I think I've survived. Hopefully, I haven't been too much of a damage to the people at home listening. All right. Do you want to do us the honors and wrap it up?
Yeah. Perfect. So I think, yeah, we spoke about stops, what they are mechanically, how they work. They're a triggered market order. Please don't forget that. Then we looked at the average true range as a way to set this up. Then we looked at an options volatility model, and we'll leave you there. We'll see you next time. It's been a pleasure. Take care.